Hi, okay. Very good morning to everybody, and thank you very much for joining us this morning. This is actually the first of the K3 Hub CPD sessions for 2023, so I'm delighted to see so many of you joining us this morning. For those that haven't virtually met me before, my name is Marie Wadeson, and I'm a Managing Director here at Quantuma, and on behalf of our parent company, the K3 Capital Group, I'm responsible for the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Since we launched in the spring of 2021, 2,300 like-minded professionals from across the country have joined our member network, through which they've accessed a range of CPD and training sessions similar to today's session, and referral fees for certain types of work referred into our group. Today, we have a 3-hour CPD session on VAT misconceptions and common errors. A few pieces of housekeeping before I introduce you to our speaker. So we are recording today's session and it will be placed on the K3 Hub website next week for those that wish to refer back. Q&A function is open, so please do feel free to ask questions as we go along. To help our speaker manage your questions, we'd be grateful if you could use the Q&A function rather than the chat. It just helps us stay on top of those questions. We will be posting the slide presentation into the chat at the beginning of the session, and then we'll do it at various points along the way for any that join slightly later. And finally, we do have a couple of short breaks planned for this morning. They'll be there or thereabouts on the hour. Okay, so on to today's session then. I'm very pleased to be able to welcome our trainer, Malcolm Greenbaum. Malcolm is a returning speaker to the K3 Hub, so I'm delighted to see him again this morning. Malcolm qualified as a chartered accountant in 1989, subsequently as a chartered tax advisor in 1995, and worked for BPP for 18 years, where he lectured on financial reporting and tax. In 2004, he moved to the professional development division of BPP and was appointed head of finance and tax programs. And then in 2008, Malcolm set up his own training and consultancy program, delivering accountancy and tax courses to accounting firms and clients across a wide range of industries. Malcolm's sessions today will broadly cover the conditions for recovering input VAT, disbursements, the supply of staff or other exempt services, the VAT implications of many common transactions, and misconceptions of the meaning of certain phrases used in the law. Just before we get going, a very quick note from me. Our next structured CPD session is on Friday, the 3rd of March. We'll be running a HR and employment law update, which is an extremely popular subject with our members. More information and registrations will follow next week, so watch your inboxes. But that's me. Over to you, Malcolm.
Thank you very much, Marie. A very good morning to everybody. Thank you for joining us this morning. As Marie said, the slides are being put into the chat, but I think if you joined the session after they were first put on, you might need to wait until they're put on again at the next point during the session. As Marie said, if you have any questions, please feel free to put them in the Q&As. I'll try and answer as many as possible within the time we have available, but still try to cover as much of the material I have planned as possible. There were some questions actually sent in before the session began. I've got 3 questions here. I don't know who asked them, unfortunately, so I don't know if you're on the call, but I'll just deal with those right now, just so I know that I've done them. And we'll probably touch on certainly for some of them, we're going to touch on the technical reasons why. I'm going to give you the answers that I give you within the actual slides themselves. So the first question is about lawyers working on immigration cases and whether when they invoice for the work they carry out, whether they should charge VAT or not. And that is a function of the place of supply of the service. So where does the service take place for VAT purposes? Now, I was planning to cover that towards the end of this morning. We'll have to see how the timing goes. But when it comes to lawyers' services, if you're supplying a business customer, a business client, then it's where they belong. And if they have more than one office, then it can be where you contract, the office you contract with, unless the office you contract with says, well, contract with us, but go and ask that office exactly what they want and give them what they want. And if that's the case, then the customer moves from the contracting party to the one that you're going to be dealing with at the coalface, if you like. When it comes to lawyers supplying services to what we call non-business customers, private individuals, for example, then the place of supply of that service is where that person belongs. which is very interesting in an immigration scenario. And so as a general principle, if the person you're working for and the person you'll therefore be invoicing belongs in the UK, either because they are already a UK resident or because they have indefinite leave to remain in the UK, then they belong in the UK. And therefore you'd have to charge them VAT. But if they haven't yet been given leave to remain in the UK, they don't belong here in the wording used by the VAT law, and therefore your supply takes place where they do belong, and that must be outside the UK, which means that your service to that person is treated as being supplied outside the UK and is therefore outside the scope of UK VAT. The second question is to do with somebody that's running a furnished holiday letting business. They run it through a website run by somebody else called cottages.com. And cottages.com essentially takes the money for the rental, takes its commission, and then passes on the balance to the owner of the property. And the question that was asked is whether, in determining whether the owner of the property has to register for VAT, does their turnover go above £85,000? Do we take the amount that the property owner receives from cottages.com, or do we include the gross amount which cottages.com received before it deducted its commission? Well, it all depends on the contractual arrangements, but I would imagine that cottages.com and similar websites are just acting as an agent for the property owner. So the supply takes place between the property owner and whoever comes to stay in those furnished holiday lettings, and cottages.com just acts as like a middle person, just bringing them together. In which case, the owner of the property has to register if the gross rental income, the gross amount of income they get essentially from the customer, goes above £85,000 in the previous 12 months. So it's gross of any commission which cottages.com would deduct. And the last question is to do with settlement sums in the context of leases. So I was asked, the questions asked particularly about a termination dilapidation claim. So I've used your premises for my business. I, under the contract with you, the lease contract, have to return it in a certain condition. But I'm not very dainty. And so at the end of the lease term, it's actually in a poorer condition than the contractual requirement. And so the landlord says, well, we've assessed the dilapidation claim and you owe us 50 grand. The question that's asked is whether that 50 grand should have VAT charged on it. Now, I presume that in this context, the landlord has opted to tax their interest in the property. So they would have been charging VAT on the rent. Because if they hadn't opted to tax, then there's no question of this dilapidation claim being VATable. It would be, for sure, exempt or outside the scope. Now, assuming the landlord has opted to tax, and we're going to talk about landed property, hopefully, this morning, assuming that the landlord has opted to tax their interest in this property, they come to me and they say, you've left the building in a worse state than contractually required, and therefore we're now charging you 50 grand. Should they now charge VAT? Well, the question you always have to ask in working out whether there's been a supply for consideration is, what has the landlord done in return for the payment they're receiving? And if they haven't supplied goods or services in return for the dilapidation payment, then the payment is outside the scope of VAT. And although HMRC did change their guidance at some point, or indicated they're going to change their guidance is not the law. And this is what I want to stress to you throughout the morning. HMRC's guidance, its manuals, its notices, unless they specifically say it has the force of law, it doesn't have the force of law. And sometimes even HMRC itself, when it goes to court, says we don't rely on our guidance. So if they don't rely on the guidance, then why should we if it disaffects our clients? So my view would be that if the landlord comes to me and says, you've left this property in a state which is worse than we contractually agreed, give me 50 grand, you're just giving them 50 grand in damages. They haven't supplied anything to you for that 50 grand. Now, I imagine that where HMRC might have been coming from by saying it might not follow its original guidance, they might turn around and say, well, if you've damaged it more than you were contractually entitled to, then you must have used it more. You must have consumed it more than you were contractually able to, and therefore you've received an extra service of using it and damaging it more than required. I don't think that argument would ever hold water in a court case. So I would still argue that dilapidation payments are outside the scope of VAT. There's absolutely no obligation whatsoever for the landlord to take that money and use it to do up the property. They can just pocket the money, the 50 grand, and just walk away and just have a dilapidated property, which they might then sub-rent or rent again later. So I think dilapidations are outside the scope of VAT. So those are the three questions I was asked even before the session began. And I would encourage you to ask questions, but if everybody asks a question, I may not have time to answer them all, in which case I do apologise, but we are limited by the time that we have available together. Now, as I say, a lot of that stuff we'll probably cover in terms of the VAT principles as we go through each section. If you have questions on any other aspect of VAT, then please do let me know. We're not necessarily bound by the topics on this list. And we can certainly depart. We can spend perhaps less time on the land and property transactions if you have other areas that you would like me to discuss. So even if they just occur to you during the morning, don't worry, stick them in the Q&As and I'll see what I can do to try and cover them. Now, as Marie said, we're going to stop about every, just round about an hour or so, slightly less than an hour, and we're just taking short breaks, a couple of short breaks. So probably totaling over the two breaks will take about 15 minutes or so, because I think staring at a screen for more than about 50, 55 minutes, trying to understand VAT is not an easy task, and your concentration may well waver while doing so. The good news is, of course, that if it does waver, you can play back the recording and hear it again if you miss something that I said. So let's crack on. Deduction of VAT, input VAT. There's an awful lot of cases that end up in court because a business claims back input VAT and HMRC challenges whether there's an entitlement to do so. A lot of businesses believe that as long as they have a receipt or an invoice that shows some VAT on it, that's enough. And it's nowhere near enough. I mean, you have to have a VAT invoice or a VAT receipt for sure, but that's only one of many conditions you have to meet. So the first condition is that the business claiming back the input VAT has to have received the supply that was made. They have to be the recipient of the supply. And there's lots of case law where the courts have sided with HMRC that although the business owns a valid VAT invoice in its name, it wasn't the one that received the supply. There was a very famous case a long time ago involving Air Tours, the travel company, the tour operator. Its banks asked PwC to write the banks a confidential report about the solvency of Air Tours and its ability to survive over the quieter winter period. So it's a confidential report. But the bank said, well, we're not paying for it. Air Tours is paying for it, which ironically would make their financial position worse. However, that's what happened. So Air Tours held this valid VAT invoice in their name because PwC included them in the engagement letter so that they could invoice them. But the courts held, because HMRC advanced the argument, that Air Tours hadn't received a supply. Air Tours' counter-argument was that it had benefited from the supply because the report was actually positive and it allowed Air Tours to continue in business. So it had benefited from the supply. There's a big difference between benefiting from something and directly receiving it. The fact was that only the banks ever saw that report. So PwC's service was actually supplied to the banks. The banks couldn't claim back the VAT because they didn't pay for it. And Air Tours couldn't claim it back because although they paid for it, they hadn't received the supply. And this is the problem we end up in a lot of cases, especially if you've got clients who run multiple businesses and they just ask the supplier to invoice business A because that has the money to pay the bill, even though the supply is made to business B. In that scenario, neither business can recover the VAT. Business A paid it, but they didn't receive it. Business B received it, but never paid for it. So unless there's a cross charge between the two, there's no chance of any VAT recovery in that situation. Sorry, a question has come in. Two questions just come in, actually. So the first question, if a company's turnover exceeds the mandatory threshold, but the services they provide are all zero rated, thus should it be exempt to register for VAT, or how to treat this? Okay, so thank you, Asma, very good question. If your turnover exceeds the 85 grand limit, but all your supplies are zero rated, then the moment you exceed the limit, you can apply for exemption from registration. So by the date at which you should have registered, you can apply to be exempt from registration if you only make zero rated supplies. And as you said in your comment, if the input VAT is negligible, so you wouldn't gain a lot by registering, then yeah, apply for exemption. But if you don't apply for exemption by the time you're supposed to apply for registration, you have to be registered. And then you might be able to apply for deregistration at some point, but you have to be registered. So you've got to meet the deadline. And a lot of clients don't, because they only tell you what happened, or you only find out what happened after the event. So Asma, the answer is you can apply for exemption, but you have to do it in a very timely manner. A question come in also from Andrew. A company purchased a new commercial business, paid VAT on the purchase. The company is fully taxable and reclaimed the input VAT in the normal way. The property is now going to be sold after being owned for 7 years. Oh, this is a fairly random property question, Andrew, out of nowhere. The property is now going to be sold after being owned for 7 years. No option to tax election was filed, as there was no need to, because there was no exempt use of the building. Is the proposed sale an exempt supply? And presumably any input VAT incurred on the sale relates to an exempt supply and partial exemption rules. Okay. Sorry, can I just ask Helen, can everybody see the Q's and A's? Can everybody see them? Okay, thank you. Thank you. So so what I'll do is just to make this easier, because it's a long comment. So I'm gonna copy it into the chat so that everybody can actually read it as well. So it's in the chat. I've copied it into the chat so you can all read it. Now, Andrew, you've opened up a real can of worms with that question, because something I was going to talk about later on, but I can discuss it now because you've asked the question. Property transactions can be any of 0 rated, 5% rated, standard rated, exempt, and outside the scope of VAT. And that's sometimes what causes the complications. Now, this is a commercial building. A commercial building sale can only ever be exempt or standard rated. If it's a new commercial building, so if it's less than 3 years since it was completed, it's standard rated. If it's more than 3 years since it was completed, then the sale of it will be exempt unless the vendor has opted to tax their interest in the property prior to the sale. Now, if your client has owned this property for 7 years and they claimed back input VAT when they bought the property, if they claim back input VAT when they claim the property and they sell it after 7 years as an exempt supply, then if the property element was more than £250,000, more than 250 grand, then that property is within what's called the capital goods scheme, which I was going to talk about later, but we'll touch on it now. So if it sells the property after 7 years as an exempt supply, then not only would it not be able to recover the input VAT on the selling costs, but it would also face a clawback of broadly 30% of the input VAT it originally claimed. So what it probably should do is to opt to tax its interest in the property before it exchanges contracts. Before it exchanges contracts to sell the property. It can do that, there's no problem. It just needs to file the option, which can be done electronically these days. So file the option and then exchange contracts. And then it would charge VAT on the sale of the property. And if it charges VAT on the sale of the property, it can recover, or sorry, it doesn't face a clawback of the previous input VAT. Next question. In a land and building transaction where VAT is large, For cash flow reasons, is there a way to agree with HMRC for reverse charge where both parties are UK based? Sunil, good question. The answer is a resounding no. Just because I can charge VAT and you can always recover it doesn't mean that we can just jointly decide not to charge VAT or for you to reverse charge it. Reverse charging only applies to very specific domestic transactions, some involving construction services, some involving things like mobile phones and computer chips, and international cross-border services. Okay, services, but not goods, absolutely not goods. So, Sunil, the answer is a resounding no. I think the next one's been answered as well. Next question, if someone runs multiple businesses and pays for an invoice for another one of the companies, then invoices the other company for it with VAT, can they recover it? Yes. Grace, that was I was mentioning briefly that if company A receives and pays an invoice for another company and then cross-charges it to company B properly with VAT charged, or alternatively, if they're part of the same VAT group, they don't have to charge VAT on intergroup supplies, then they can recover the input VAT. The only problem, Grace, is where business A pays for the invoice, but company B receives the service and nothing else happens. So the answer to your question is yes. Is there a time limit for a party to issue a VAT invoice after a property transaction has taken place? Generally speaking, you are supposed to issue a VAT invoice within 14 days after the date of supply. So technically, you're supposed to invoice within 14 days. Problems do arise because sometimes there are delays in assessing the consideration figure. There are delays caused which are outside the control of the vendor, in which case HMRC may not take a dim view if it's invoiced after 14 days, but technically the law specifies that it should be within 14 days after the date of supply. And the last question for now is if a VAT registered business sells product outside the UK but gets paid by the agent of the importer based in the UK, is that supply still treated outside the scope? Sanjay, you'll have to just give me a few more details. I'm trying to work out whether the item is exported from the UK or whether it's already outside the UK when the business sells it. So I need to know that to give you an answer. So please come back to me with an answer to that, and I'll answer your question with pleasure. Helen, just leave that question up there, please. Okay, so we've got to the first line, the first bullet point of the very first technical slide, and we've had quite a few questions. That's what I was expecting. I'm delighted to answer these questions. They're all very practical questions, so I'm delighted to answer them. But it probably means we won't get to the end of our presentation. So what I'm going to try and do is, as you ask a question, I'll hopefully better tick off something that I was going to talk about in the slides. So when we get to that part, if we ever get to it, I won't need to address it. I'll just tell you, look, we covered it earlier. Play back the recording if you want to, but we did talk about it earlier. So thank you, Sanjar. So if goods are exported from the UK and the importer is your customer, then that can qualify for zero rating. It should still be, it's not outside the scope, Sanjar. It's zero rated. It's a zero rated supply. Next question. If a builder purchases materials on behalf of a customer and it's reimbursed for the cost, is this a supply for VAT purposes? Yes, it absolutely is. Okay. What you have to look at, we're going to look at this in a moment, actually, Dominic, is whether that's a genuine disbursement or not. So hold that thought, but I would argue that in that case, the builder would have to recharge with VAT unless they were buying materials, which they then incorporate into the construction of a building where the construction would be zero rated. So if they were buying materials on behalf of a customer to build a house for them, and they're just going to invoice for the construction of the house, including the materials, the whole thing is zero rated. But if the builder is buying materials to carry out a repair, to carry out an extension, to carry out a refurbishment, all of which would be standard rated, then they would have to charge VAT on the whole lot. If it was clear that the builder was acting as an agent for their customer, if that was clear, and the builder's merchant or whoever sold the materials knew that the customer of the builder was their customer, it wasn't really the builder's customer, it was their customer, and they were to invoice, for example, in the name of the end customer, then we might be able to argue that the builder is an agent. But we're going to talk about that very shortly, Dominic. Okay, so hold that thought. Okay, anyway, back to our input VAT recovery, which we just about started. So the business claiming the VAT has to have received it. That's the first thing. VAT must have been correctly charged by the supplier at the correct rate. If the VAT rate or amount shown on the VAT invoice is incorrect, you have no right to recover it. And there aren't many businesses who actually check whether VAT has been correctly charged. And I've seen loads of situations in real life where the supplier has charged that and they shouldn't have done. And that technically means that the customer can't recover that VAT. Most customers don't know that, so they recover it, and then HMRC does an inspection later and then discovers this and raises an assessment to recover the amount that was charged. They just say to you, well, go back to the supplier. They shouldn't have charged you that. Go back to them and get it back from them. Well, good luck with that. So it's always best to challenge any VAT charge that you think is incorrect in the first instance. The business must have paid for that supply. And if they haven't paid for it within 6 months of the date when that supply was due to be paid for, then the customer has to pay back the input VAT that they might have claimed in an earlier quarter. And that's probably done because at that point, if the customer hasn't paid the supplier within 6 months of the due date, then the supplier is entitled to make a bad debt claim. If they've paid over output VAT on the sale and the customer hasn't paid them within 6 months of the due date, they can recover that output VAT from HMRC. And so this rule is kind of put there to make sure that if that does happen, then at least the customer has paid back the input VAT that they originally recovered. So from HMRC's perspective, they would break even if that all happened. We can recover pre-registration input VAT. So we can recover VAT on certain items, goods and services before we actually registered. For goods, which includes not only stock or inventory, it includes fixed assets as well, things like equipment, vans, lorries, that sort of thing. As long as you still own the goods at the date of registration, then you can recover the input VAT as long as you hold a valid VAT invoice for it. Although there is a general time barring of input VAT recovery if it's more than 4 years since the quarter in which you incurred the VAT. So any VAT that's more than 4 years old at the date of registration, that won't be recoverable. For services, it's a much stricter rule. The services must have been completed within 6 months prior to the date of registration. And it's important that we can distinguish between goods and services. Yeah, goods are physical assets, services are essentially anything else. Now, HMRC a while ago issued some guidance, or sorry, they said they were changing their interpretation on fixed assets. Because they had this view that if, for example, you start a business, not VAT registered, you haven't exceeded the turnover threshold, you buy a new van for say 20 grand plus VAT, you're not VAT registered, you can't recover the VAT. Say 2 years later, you breach the VAT threshold, you've got to register. HMRC's view was, but you've already used the van for 2 years and you've made supplies of which you didn't have to account for output VAT. So what you should do is to value the van at the date of registration and only claim back the input VAT on the current value of the van, which will be less than the original price you paid. And a lot of very well-known VAT commentators actually said, yeah, that makes sense. Yeah, that makes perfect sense. Well, it might make sense, but is it what the law says? And the answer is no. The law doesn't say anything like that. So having issued this revised policy in a great fanfare, they were forced to retract it about 6 months later because the law didn't back it up. If your client buys a van when they're not VAT registered and they got a VAT invoice for it, and then a couple of years later, 3 years later, they register and they still own the van, they can claim back all of the VAT that's on that invoice. There's no mechanism for apportionment. Another question came in. When a company is newly formed, can they claim back pre-registration costs as well? Yes, there's specific laws about this, Tejas, that if a company is newly formed, then if a director has incurred input VAT while they were getting the business set up, and they hold a valid VAT invoice, and they do become a director of the company afterwards, and the company reimburses the director for that cost, which can just include a book entry, an accounting entry, to credit a director's loan account to say that the company owes the money to the director, then yes, the company can claim back that pre-incorporation VAT. HMRC has taken a couple of cases in the last few years where they've tried to argue that isn't the case. And in both cases, the courts agreed with the companies that they were entitled to VAT recovery. Ryan, can I claim for services pre-registration if they've been used? Absolutely you can, because it doesn't say anything about services being consumed. So the answer is a resounding yes. I was recently dealing with a flying school, which has had to register for VAT because its turnover has gone above the 85 grand limit for the first time. And they have lots of sort of maintenance costs on aircraft. And they've got maintenance costs in the previous 6 months. That maintenance has already been done. Yeah, it's sort of fixed stuff. They put new oil in. The oil's probably been used by then. It doesn't matter. You get that VAT back, no question. Nigel, the question doesn't make a lot of sense, but I think I can make sense of it. So if the pre-registration cost is a new roof on a property, is that a good or a service? Interesting. The supply and installation of a new roof. I would say that the roof is goods. It's physical property. But it would rather depend on what the invoice says, Nigel, as well. Yeah. So if the invoice talks about services provided to replace roof, that's not good news. But if it's a physical new roof, so that's, the cost of the tiles, for example, absolutely, that would qualify. But if there's like a separate charge for the tiles and a separate charge for the installation of the tiles, the fitting of the tiles, then for the fitting, that would have to be within the previous 6 months. But the tiles themselves, that should be okay. Because it's just part of a building, I think you might be all right. There have been cases in the past where I think it was like a horse riding school. They had like an arena built. So there's physical goods there, but the courts held that that was essentially a construction service to build this thing, and as such, because it was finished more than 6 months before registration, they couldn't claim back the input VAT. But replacing a roof that's already there, it's not a construction service per se, because you're not starting from scratch. I think as long as the tiles were invoiced separately, it would be fine. I've got a feeling that if it was all invoiced as one supply, HMRC, if they discovered it, would argue that it was a service. And if it was more than 6 months prior to registration, they would disallow it. So make sure that the goods are invoiced separately from the construction service, and you'll be fine. You have to retain evidence that a supply was received and that VAT was charged. And in virtually every single case, you have to hold a valid VAT invoice. Now, do you know what goes on a valid VAT invoice? Do you know all of the content of a valid VAT invoice? Because there's a lot of stuff has to go on it. There's about 14 or 15 different things that have to appear on that invoice. And if they don't, it's not valid. And if it's not a valid VAT invoice, you're not entitled to the VAT recovery, even if the supplier has charged VAT. So not many businesses, again, check that the VAT invoice they receive contains everything that's needed to be on there to make it valid. I've seen valid VAT invoices. Sorry, I've seen VAT invoices, I apologize, being issued without a sequential number. They have no number. And it's a requirement of the VAT law that a VAT invoice has a sequential number. So it could be as simple as that. But a full VAT invoice has to have the supplier's name and address, customer's name and address, excuse me, VAT registration number on it, sufficient description of the goods to identify, or services, identify what was supplied. So an invoice that just simply says for services rendered, probably not good enough. Probably not good enough, because that's not enough to tell whether VAT's been correctly charged. It needs to have the rate of VAT for the supplies. It has to have the net value of the supplies overall, the VAT amount, and so on. If the amount of the supply is less than 250 quid, including VAT, then the supplier, if they're a retailer, can issue a less detailed receipt. So if I want to replace my trusty printer here, and I went to PC World and I bought a new printer for my company, they would give me a VAT receipt, but it wouldn't have my company details on it. But because it's less than 250 quid, that's okay. I can claim back the VAT on that. Another question come in. Can I claim input VAT on an invoice where the customer's name is incorrect on the invoice? So company PLC, when the customer's name is Company Southeast Limited. Stephen, that could be very problematic. Yeah, I mean, if it said Company Southeast PLC rather than Company Southeast Limited, I don't think that would be a problem. But if it just said Company PLC, when the full name is Company Southeast Limited, I think that would be a problem. My company is Greenbaum Training and Consultancy Limited. And I get people sending me invoices that say Greenbaum Limited. And I write back to them and say, can you please re-invoice it using this name? So I'm very particular. I mean, I know a lot about VAT, obviously. I go out and say, can you please invoice in our proper name? But I think as long as the main thrust of the name is there, that's enough. For example, if they missed the word limited off the end, but they had Company Southeast, I think that'd be fine. I don't think that would cause any problems, particularly. Yeah, Liam, where can you find a list of requirements? It's in the general VAT regulations, which is statutory instrument 1995. I think it's 2518. Yeah, it's 2518, I think. It's the general VAT regulations. It's all in there. Okay. That regulation, by the way, has about 200 paragraphs to it, but it's contained within there. Okay. Or you can just Google VAT invoice requirements, and it'll probably link you to an HMRC page, which will show you what they think the requirements are. Annie, can you reclaim VAT on receipts from supermarket purchases, which doesn't have the VAT breakdown, but their VAT numbers on the receipt and the item purchased is a taxable item? Annie, a resounding yes, you can. You absolutely can. If you look on a supermarket receipt, what they often do is they put some symbol like a star against the items which are VATable. Which are VATable at the standard rate, as opposed to being zero rated. So you absolutely can. I've done it many, many times. What if the VAT invoice isn't a sequential number, Roseanne, but rather a number that's unique to the business that issued it? Oh, interesting. Roseanne, you'd have to explain a bit more about how that worked. Just maybe like an example, and then I'll be able to answer it. Does the 250 limit refer to as a printer apply elsewhere, for example, phone bills? Clients often have mobile bills in their name and pay via, okay, Peter, this is a problem. Okay, if you've got a mobile phone bill in the name of an individual and the business is trying to recover the VAT, doesn't work. HMRC, if they discovered it, would disallow the VAT. And that can also cause pay as you earn or employment tax problems as well, because essentially the business is settling a liability, which is actually that of the individual. So the settling of the bill by the company could actually be treated as being earnings for employment tax purposes for the individual. So Roseanne, the invoice is not in a numerical sequence. If it's not sequential, and it doesn't necessarily need to be numerical, but it has to be sequential, then that could be very problematic, actually. Yeah, very problematic. It does say that it needs a sequential number. But if you had invoice 1A, invoice 1B, invoice 1C, invoice 1D, invoice 2008-01, invoice 2008-02, that's all fine. Yeah. But if it's not sequential, that is problematic. Very problematic. what if you disallowed a portion of the mobile bills that aren't in the company name to drawings? The problem you've got, Annie, is that if the invoice is not addressed to the business, then the general principle is it shouldn't be able to recover the VAT. If your client businesses, if your client's businesses, companies want to recover VAT on phone bills, they have to have business contracts. That's what we've got. We've got a business contract for the phones that we need in the business, because then it puts the matter completely beyond doubt. I think that if you're claiming back input VAT on a bill that isn't addressed to the company or the business, you're going to have a problem. The only exception to that rule is hotel bills. So, for example, on Sunday, I'm going down to Gloucester. I'm doing some work in Gloucester Monday, Tuesday. I'm staying in a hotel. The bill will be in my name. And as a result, you might argue, well, then the business, my company can't recover the VAT on the hotel stay. It can, yeah, because HMRC accepts that hotels will bill in the name of the person that's staying there. I have had problems in the past with Amazon, because I don't really want a business Amazon account, but I want to buy stuff from Amazon for my business. And I've had it with other businesses at all. I've had other businesses, I've had other suppliers with the same issue. Some of them won't let you have it, like a company account. So what I've done is in the first line of the address, I put the company name. So my name appears at the top, the first line of the address is the company name, and then the address follows. And then I have an invoice that has the company name on it. Robert, the issue of sequential numbers is only a problem for the supplier. How can a customer know the supplier numbering system? That's a good point. It's a very good point. But Robert, I have to tell you that if I got an invoice and I think it was Roseanne, I think what Roseanne was saying was that almost like the supplier has a unique code almost for a particular customer or a particular piece of work. If I saw an invoice that didn't have a regular number or a very, very simple alphanumeric number, I would query it, because I'd be very concerned that wasn't sequential. Frankly, to be honest, Robert, it's up to the customer to satisfy themselves they're looking at a valid VAT invoice. And if it wouldn't be reasonable to conclude that was a valid VAT invoice, they're not entitled to VAT recovery. Would HMRC pick it up, Robert? Different question. But I'm talking about, trying to be holier than thou or holier than whiter than white to make sure that there's never any doubt about your input VAT recovery. Peter, can the sequential numbers be relevant to individual sites? Yes, they can. They can. They just have to be in a sequential order. So a company that has different sites can put like an alphanumeric code at the beginning, and that would be okay. But if the invoice number was like a random selection of letters, for example, I'd be very concerned about it. Very, very concerned about it. And I'd ask the question. Personally, I'd ask the question. I ask the supplier, what's this invoice numbering system you got here? Input tax mustn't be blocked by the law. Okay, it mustn't be blocked by the law. We can't recover input VAT in the UK on the purchase of a car unless we can prove that it could only ever be used for business purposes. That's almost impossible to prove. Or if the supply relates to entertainment, unless it's reasonable staff entertainment. And just to stress, it's the entertainment that has to be reasonable, not the member of staff. So reasonable staff entertainment, you can recover the input VAT on. But any other type of entertainment whatsoever, contractors, suppliers, customers, potential employees, past employees, so retired employees, you can't recover the input VAT on any of that entertainment. Now that's our law. Different countries have different laws, because even though we've left the European Union, a UK business still has the basic right to recover input VAT it incurs in other European Union countries. Now, for example, if I go to Germany, and I was in Germany yesterday, if I go to Germany and I incur input VAT entertaining a German client, then I can make an application to the German tax authorities, subject to any de minimis limits they may have for recovery. I could go to the German government and I could recover that input VAT, because Germany allows you to recover input VAT on entertainment. I'm going to Ireland next month. The Republic of Ireland, its domestic VAT law says that you can't recover VAT on car hire, the fuel for the car, hotel stays, and subsistence costs while you're there. So if I incur, and I do incur those costs in Ireland, because I'm normally traveling someplace out the way, then I can't apply to the Irish government to recover that VAT. Because they won't let their domestic businesses claim it back. They're certainly not going to let an international business, a foreign business, do so. Okay, there is some case law, but that I've talked about some of it already, so I'm going to skip over that for now. If a company's only employees are the directors with salaries, can input VAT be claimed on an annual function? Yes, it can, Stephen. Yeah, it can. My wife and I recently had an annual staff party. We're both directors of the company. We had our annual staff party. You can recover the VAT on that. Eldika, I think you asked the same question. Yeah, except for partners, yes? Oh, I see. No, it's a different question. It's a very good question. Is annual party VAT allowed for staff partners? I think you mean partners of staff, yes? Domestic partners of staff. So spouses, etc. The technical answer is no. So if you have a party where the spouses or partners are invited and the cost is, I don't know, £5,000 plus VAT, then generally speaking, you can only recover the VAT that relates to the members of staff that attended. There's no benefit, there's no taxable benefit for income tax purposes on the employee whose partner comes with them, as long as it's below a certain de minimis limit, but you can only get VAT back on half. Now, what the company could do, the business could do, although it might be a bit unpopular, is to say that you can bring your partner with, but we're going to charge you 12 quid. We're going to charge you £12 you want to bring a partner with. Bargain, because it costs you like 100 quid, but if we're going to charge you 12 quid. And then what the business is then doing is selling an entertainment service to the employee or their partner. The business would account for output VAT on that supply. So 1/6 of the £12 they're charging, 2 quid, it's 10 quid plus VAT. And that would entitle the business to recover all of the input VAT for that party. So you can kind of get round, the lack of recovery of input VAT on anybody other than employees by charging consideration for that entertainment. And it doesn't have to be the full cost or more. It just has to be a reasonable amount of consideration. So that's why I say it's like 12 quid would do it. Okay, let's move on. Supply of staff or supply of services. This is a pretty burning issue at the moment, going on in the background at HMRC, and I've been involved in a particular case that's been going on for about 3 or 4 years now. Katie, I'll come to your question in a moment, if that's okay. So if a supplier is providing manpower to a customer, is that the supply of the relevant service that might be being supplied? If it's a medical service, it might well be exempt from VAT. Or is it just the supply of people? And the supply of people, the supply of staff, the supply of labour is a standard rated supply. And HMRC has had a lot of success here with companies being set up to either recruit as employees or use as freelancers doctors and nurses, and then supplying those doctors and nurses services to hospitals, be they private, be they NHS. And HMRC has successfully argued that the companies that have been set up to supply these medical people are just supplying labour. They're just supplying people. And even though these are doctors and nurses who are being placed in hospitals to provide medical care, the supply by the private company is standard rated. And the key test here of whether you're supplying people or services is whether the people doing the work come under the direction, control, or supervision of the customer, the end customer. Now, if I form a company to place doctors and nurses that I can find with hospitals, I don't know the first thing about medicine. I'm not a doctor. And even if I was, I don't know what those doctors and nurses are being asked to do when they go to the hospital. They'll be told what to do by the hospital. So those people are coming under the direction, control, or supervision of the hospital they're being placed in. And therefore, all I'm doing is providing human resource, which the hospital then directs. So my supply is one of staff and is standard rated. The case I've been dealing with is a bit different. I've been dealing with professionals called perfusionists. Most people don't have the faintest idea what one of those is. And frankly, I didn't until I first came across this. A perfusionist has one function, that if there's an operation taking place and the patient has to go on bypass, then the perfusionist is the one that tells the surgeon when they can put the patient on bypass. They monitor the patient and intervene while they're on bypass. And when the surgeon says they want to take the patient off bypass because the operation they've done is concluded, then they can't do so until the perfusionist has finished doing their stuff and tells the surgeon it's okay. So they have a very, very specific role. And we've been arguing with HMRC now for about 5 years that that is not the same as providing a general doctor or nurse. And most recently, they've written to us saying that we're sorry it's taken so long. They're obviously still thinking about it. And if we decide, in our opinion, that your client should be registered, we're not going to apply it retrospectively, because they shouldn't have to wait around for 5 years wondering what's going to happen. But we still don't have a conclusion. So it is nuanced. And you might most likely would need to take professional advice if you found yourself in that kind of situation. Okay, somebody asked a question earlier about what if a builder buys some materials on behalf of a customer and then recharges it to the customer? So we're going to cover that when we talk about disbursements momentarily. But I had a question came in from Katie. Katie, I apologize to keep you waiting. So you said we had an Amazon invoice for goods. The supplier was Hong Kong based with a Hong Kong address. They had a GB VAT number and the invoice said that domestic reverse charge. Is the invoice correct? Ooh, domestic reverse charge. Ooh, interesting. If they're a foreign supplier and they were supplying goods to you in the UK, goods, not services, then they should have charged you VAT. I can't see how domestic. I suppose the question is, what were the goods, Katie? What actual goods were they? I'd need to know that. But in principle, no. Oh, okay. So unless the goods were things like mobile phones or computer chips, something like that, then I don't know how domestic. I don't know why it would be domestically reverse charged. I have to tell you. In my opinion, that Hong Kong supply. Oh, okay. It might depend upon the terms of trade. Yeah, it might depend upon the terms of trade. Because if they were delivering those goods to you delivery duty paid, then they would have an obligation to clear those goods through UK customs, and then would be treated as making an onward domestic supply to you, on which they would have to charge you VAT. But if they were exporting those goods to you, and it was any other term of trade apart from delivery duty paid, then you would have the obligation to clear them through UK customs, and you would have the obligation to account for input VAT. So without knowing the terms of trade, it's very hard to say, Katie. There is a possibility that whilst I wouldn't refer to it as domestic reverse charge, there is a possibility that you should have accounted for the VAT as import VAT, possibly through your VAT return, or possibly by declaring the goods to customs. So without knowing more details, it's hard to say. On the balance of probabilities, I think they should have charged you VAT, UK VAT. And if they haven't, that's not your problem. That's their problem. Okay. Disbursements. HMRC has issued guidance on what it considers to be what we call a true disbursement, which is very nice of them. There's a slight problem. The law doesn't say anything at all about disbursements. And a lot of people get it completely wrong. So in a lot of cases, what they're doing is basically charging a higher price for their goods and services to recover certain costs that they've incurred. So, for example, as I told you yesterday, I was in Germany yesterday, so I flew to Germany, and the flight is zero rated. There's no VAT on the flight. I do some work in Germany. I bill the client in Germany for the work I've done, and I'm going to bill them also for the flight. Well, the flight is my flight. I booked it. My company booked it. I flew on it. So I'm not selling my customer air tickets. I'm selling them a service. I want to charge for the service my time, and I want to recover the costs I've incurred. So I bill them the total. Let's say it's £1,000 for the work, and I've got air and rail fares of £200 on top. And let's say that they then ask me to post them something that costs £10, and I want to recover that as well. I've got to charge them VAT on the whole amount, because none of those incidentals, the airfare, the rail fare, the postage, none of those are transactions that took place between the original supplier and my client. They all took place between the original supplier and me. I bought the air tickets, I bought the rail tickets, I bought the postage, and I'm now just recharging it to them. So I've received a supply, and I've made an onward supply to my client. I've got to charge them VAT, if I would charge VAT in that scenario. So the example with a builder, if the builder's gone to a builder's merchant and bought some materials, then that's a transaction between the builder and the merchant. If the builder then recharges that cost to the customer, that's a separate transaction. You only have a disbursement, where the transaction is actually between the original supplier and somebody else, your client. But you perhaps agree to pay the amount up front just to make things more efficient, to make the transaction occur quicker. Which means that you have really nothing to do with the transaction apart from you've agreed to pay it, which is essentially akin to sort of lending them the money to pay it. So when you ask them for the money back, that's all you're doing, is asking for the money back. That's a disbursement. That's a disbursement. Nothing else is. So HMRC comes up with all these guides, these 7 conditions before you have what's called a disbursement, and you don't have to charge VAT on it, but it's much, much simpler than that. And these conditions don't have the force of law. You just look at the transaction. Am I just sitting here in the middle and the transaction is taking place between 2 other people, but I happen to pay the bill on behalf of my client? If that's the case, you have a disbursement. In any other situation, you do not. So they give 7 conditions. The Law Society itself, because obviously legal firms claim they have a lot of disbursements themselves, they say there are 5 conditions, but then say they're not exhaustive, which is not very helpful. But frankly, the principles I just gave you are the only ones you have to think about. The VAT law doesn't address disbursements specifically. It doesn't have to. If I make a supply, I've got to charge VAT. If I don't make a supply, I haven't got to. So if you got an invoice from your supplier, so it's addressed to you, and you say to me, could you pay this for me, and then I'll pay you back, well, fine, I'll pay it. It's not my supply. I don't get the invoice. I ask you for the money back. I ask you for the money back. I don't really have to put it on an invoice. You could just transfer the money to me and that would be it. That's a disbursement. Nothing else is a disbursement. So, listen, I think we'll stop for a coffee break at this point because we've been going for just under an hour, I think. So let's stop for, well, let's come back, please, at around about just before 10:10, and we'll pick things up from there. Any questions that occur to you during the break, by all means, feel free to include them in the chat. So quite a few questions come in during the break. Quite a few questions come in during the break, which I'll try and work through. Nicola, you put one into the chat. If you wouldn't mind putting them through the Q&As, that would just help me so I haven't got to look in different places going forward. It's absolutely fine. I can see it though, don't worry. I'll take these in the order they appear. First question, if the client was recharged only the cost of the disbursement and the business didn't recover the input VAT, would output VAT still need to be charged? Peter, that scenario doesn't change anything at all. If the business received that supply and they're now recharging it to their clients, then they've got to charge VAT if it's a VATable supply, if what the business is supplying is a VATable supply. The fact that the business didn't reclaim input VAT for whatever reason doesn't necessarily affect the output VAT that it would charge, unless there's something quite specific about why it didn't recover the input VAT. Ryan, disbursements, does the VAT invoice have to be in the customer that's receiving the name, or can it be in the agent's name that pays for the goods or services on behalf of the customer? I think it could be in the agent's name, Ryan, but the description would have to say goods and services supplied to XYZ Limited, so that it was clear who received the supply. Liam, a client has solar panels fitted at home, bought the panels from a commercial VAT, and then paid an electrician to fit them. Okay, so I think subject to certain conditions, the installation of energy saving materials can be zero rated. But I've got a feeling that you have to have the same person supply and install the materials, because there's a 60% test that's mentioned in the VAT law. It's in Schedule 7A of the VAT law. Well, at the moment, it's been moved, apologies, to Schedule 8 of that. It's become zero rated. But it talks about the fact that the total value of the total value of the supply, the cost of the energy saving materials, if it exceeds 60%, then the whole thing is zero rated. But if it's less than 60%, then the labour cost is zero rated. I'm just wondering whether labour cost on its own would qualify. Interesting. Just give me 2 seconds. I'll just have a quick look. Schedule 8 of the VAT Act. So I want to see the exact wording of the law. So it's not mentioned there. Oh, here we are. It's Group 23, blimey. Okay. Group 23 of Schedule 8 of the VAT Act. Relevant supplies of installing energy saving materials in residential accommodation in Wales. Energy saving materials for solar panels, residential accommodation. Yeah, should be zero rated. Liam, it should be zero rated. So the fitter is talking rubbish. Okay. Andy, a group of companies with one topco and 3 subs. Is it okay for only one company VAT registered? Its turnover is over 85k. The other companies, including top companies' turnover, are all individually under 85k. As long as the business is not trying to artificially split its supplies, then I don't think there's any problem whatsoever, because each company is a separate VATable person unless there's a group VAT registration in place. Craig, if as usually the case, I pay for a client their land registry fee to register a purchase of property, do I charge them VAT on the land registry fee? The question is, who is the transaction between? Who is obligated to register the land? And Craig, the answer is the buyer is obligated to register the land. You're just doing it on their behalf. If that fee wasn't paid, who would they sue? Who would the land registry fees? Who would the land registry register sue? It wouldn't be you. It would be your client. So as long as you only recharge the cost of doing it, the cost of the fee, that is a genuine disbursement, and you don't charge that. Deepa, your question is way too general. Way too general. I can't answer that question. Disbursement cost for solicitors, is it VAT or not? It depends what was incurred. I gave you the principles earlier, which is that if the transaction is between you and a supplier, they invoice you in your name, and then you recharge that cost to your client, then the recharge is part of your fee, just like my flights, and it's VATable. If the invoice that's raised by the supplier is to your client and you're just paying the bill on their behalf, then that's a genuine disbursement. If a client builds a garden office attached or detached from the property, are they able to claim back the VAT on the cost of materials? Tejas, that's a much wider question I can really answer today, because it goes much deeper than just VAT recovery. Technically, if the company pays for the office, then yes, they can get the VAT back if it's going to be used for business purposes. But that then creates all sorts of other tax problems. So before a company pays for a garden office to be constructed, you've got to think very carefully about all the tax implications, especially if it's an extension to the existing house. Because then what you'll probably find is that the cost of the extension has to be, if it's paid by the company, has to be treated as either a benefit or earnings for income tax purposes of the directors of the company, because it's enhancing the value of the property, which is owned by them personally. If it's a separate office, garden office, it's less problematic, except when you come to sell it later, because then you're selling a property where you own part of it personally and a company owns part of it as well. So what does the deed of sale look like? Do you have to have two contracts? One, the company selling its office, and two, you selling the house and the rest of the garden. So it's highly problematic. Simon? When a letting agency organises an EPC for a landlord and charges the client a commission on top, should the full charge from the letting agent be VATable? Yes. If you recharge at a margin, Simon, then it cannot be treated as a disbursement. So it has to charge VAT on everything. And Nicola, your question in the chat. I work for a mystery shopper company. A shopper visits a restaurant and reports on the service. The shopper sends us a receipt, which we then claim input VAT on and pay the shopper back. I presume the shopper is some sort of individual who's either employed by the company. I presume they're employed by the company. If they're not an employee, that could be a bit problematic. And it might be that the shopper would have to recharge it, which probably wouldn't have VAT on it. That could be a problem getting the VAT back unless it's an employee of the company. We then add this to our sales invoice as the net plus VAT as a disbursement. But as the tip is exempt from input VAT, when it comes to sales invoice, we claim output VAT on the tip. I don't understand what you're saying in that last point, Nicola. I do apologise. You might need to clarify. Perhaps you can come up with a little example with some numbers, put it in the Q&A. I'll have another look at it. Just before we go on, in fact, we're not going very far in the notes in the slides, but I did look up the VAT regulations. It doesn't actually say sequential number, but it says an identifying number. It says identifying number. So in my view, it has to be numerical. So having some sort of code with letters certainly wouldn't work. Kashif. Input VAT not allowed for purchase of cars except in certain situations. If someone wants to buy a car with gross weight between 2.6 and 3.2, would that be a commercial vehicle? No. Kashif, a commercial vehicle is one which, for VAT purposes, is one which has been designed to principally carry goods. Designed to principally carry goods. The fact that it can, and it can carry 1 metric ton of goods, doesn't actually really matter from a VAT perspective. If it's mainly designed to carry goods, it's a van and you get VAT back. If it's not mainly designed to carry goods, you modify it to carry goods, you can't get the VAT back. Tom, if you have cost of, that's pre-registration. Pre-registration service, which is part of a piece of work you completed prior to VAT registration and have invoiced the customer for, can you claim the VAT back on the service? Is that within 6 months of the registration? So you've paid for a pre-registration service, which is part of a piece of work completed prior to VAT registration. You then invoice the customer later for it, presumably after you've been VAT registered. Can you claim the VAT back on the service if it's within 6 months? Yeah, absolutely. There's no condition particularly put on the service other than it must have been completed within the 6 months prior to registration. So I don't see a problem with that at all, Tom. Thank you for the questions, by the way. We're not going to get through all the material. There's no way in a million years. But I think if I'm addressing your questions, then that's the most important thing, because I could be covering stuff in the slides, which is not so relevant to you. So keep those questions coming, please. Perhaps next time we just make it a 3-hour Q&A session, because we could certainly do that. And we'd have plenty of questions to answer. Now, we were talking about disbursements just before we stopped for a short break. This first one I think is quite informative and deeper. It might actually answer some of your questions, I hope. So let's say that you have a client account and your client instructs you to transfer money from that account to a third party, which you do, and the bank then charges a CHAPS fee, a transfer fee. Don't charge you VAT because the service of transferring money is an exempt supply for VAT purposes. In that case, the bank has supplied its services to you because it's your bank account. Okay, it's a client account, but it's your bank account. So they've invoiced you. Oh, sorry, they've charged you. They won't invoice you, they've charged you. So when you then, if you want to pass on that cost to your client, it's a bit like the airfare or the postage charge. If you pass on that charge as part of your invoice to your client, you have to charge VAT on the whole lot, because the bank has not supplied a service directly to your client because it's your bank account. Okay, it's your bank account. They may not have the faintest idea who the actual client is because it's just client money sitting in one big account, and you just ask them to transfer a certain amount from that account to a third party account. Somebody asked about land registry fees before, and SDLT. SDLT and stuff is certainly disbursements, because the arrangement has to be between the party trying to register the property and the land registry. Now, electronic search fees are much more problematic. Most lawyers these days, if a client is engaging in a property purchase, will essentially outsource the property search to a third party. So the third party will produce the report, send it to the lawyer, and the lawyer will send it to the client. My two elder children recently bought flats, and that's exactly what happened. Now, this Brabner's case is really important, and a lot of lawyers haven't actually internalized the impact of that case. Because in the Brabner's case, we had this arrangement, third-party outsourcing of the search fees, the property searches, sorry. The search company would then invoice on a monthly basis the lawyer, and the lawyer would then pass on that charge to their client. So because the electronic search company was invoicing the lawyer, and it was the lawyer who essentially outsourced it to them, as a buyer of a property, I don't have a faintest clue who's doing the search. I just asked the lawyer to arrange a search. So the contract is between the outsourcing company and the lawyer. So they get an invoice from the outsourcing company. They should claim back the input VAT on that invoice. When they recharge it to their client, then they should be charging VAT. Because the lawyer in that case is not sort of standing back from it. And there's not like an arrangement where the outsourcing company has contracted with the end client. The outsourcing company is contracted with the lawyer. So that's one supply. And then when the lawyer recharges it, they're just charging a bigger fee to recover their cost. They should be charging VAT. And I still see lawyers not charging VAT on property searches. Okay, land and property transactions. We had a few questions earlier about this. I'll try and get through this section as efficiently as I can. We could, in fact, spend 3 hours on land and property and still wouldn't cover absolutely everything. One thing I want to just mention briefly is the reverse charge for construction services. The reason for mentioning it is because although it came in from March 21, the HMRC said they wouldn't charge penalties on mistakes made, careless or deliberate mistakes made, until the 1st of March 22. So this would be around the time where they might start picking up mistakes and wanting to charge penalties. So in order for domestic reverse charge to apply, now what is reverse charge? Normally, the supplier charges the customer VAT. In a reverse charge, the customer charges themselves VAT. So the rules are, the conditions are, sorry, that both the subcontractor and the main contractor are VAT registered, that the main contractor is also registered under the CIS scheme, Construction Industry Scheme. The work that's being done is within the scope of CIS. It's a construction operation. And you'll find the details, it's in Finance Act I think it's 2004, it defines a construction operation. The work is subject to a positive rate of VAT, 5 or 20. We'll find out the VAT ratings of property transactions soon. But it's not something like a zero-rated operation, such as building a new home or a new block of flats. And the fifth condition is that the main contractor, that is the customer for this service, is going to be recharging that service to somebody else, to what we call an end user. Now, unlike construction industry scheme, the VAT treatment would apply to the whole invoice. Either an invoice is reverse charge or it's not reverse charge. So any materials that are being recharged as part of the construction service, they follow the same treatment as the construction service itself. Now, the sort of areas that I have got involved in with very large construction businesses. This example came from a work I did with a very big Irish, Northern Irish construction company. Let's say that the company is constructing some dwellings and a subcontractor installs fitted wardrobes in the bedrooms. Now, fitted wardrobes don't get classed as a fixture which is ordinarily installed in dwellings. It's not like fitted kitchens or things like boilers, etc. So any fixture which you wouldn't ordinarily install in a dwelling doesn't generally qualify for zero rating. The rest of the building, it's a home, a new home does, but this sort of stuff generally wouldn't. So the question I was asked is whether the subcontractor should charge the company 20% VAT or whether the invoice is subject to reverse charge. Should the customer, should my client deal with the VAT themselves? So the fitted wardrobes, as I say, are not zero rated because they're not goods ordinarily installed in dwellings. There's a rule about that. And assuming that the subcontractor and the main contractor are VAT registered, assuming that the main contractor is registered under CIS, well, it's building houses, so it almost certainly is. Assuming this would normally be standard rated or 5% rated, it would be. And assuming that the main contractor is going to pass this cost on to its own customer, it is. It's building houses, then going to recharge the construction service, then it would qualify under reverse charge. The supplier should not charge VAT. Technically should write on the invoice, domestic reverse charge applies, and then the main contractor would reverse charge it in their accounting system, which I'll come to shortly. Now, a second example I came across, which I thought was interesting, because it just illustrates the approach that you should take to working out the right answer. So I don't know everything about VAT law, by the way. I know it might seem that I do, but I really don't. I look it up as I looked up stuff at the break. So a subcontractor plants trees and shrubs that aren't required by planning consent. If they're required by planning consent, they are an integral part of the construction of a property. They follow the VAT rating of that construction. But if they're just a nice to have, it'll make the place look prettier and therefore more saleable, but there's no planning consent that orders it to be done, then that doesn't qualify as an integral part of the construction of the property. So, excuse me, again, the question I was asked is whether the subcontractor should charge 20% VAT or whether it should be subject to reverse charge. Well, trees and shrubs aren't zero rated because they're not goods ordinarily installed in new dwellings if they're not required by planning consent. Now, if you read the law about what is a construction service, it says that landscaping is a construction service. Section 74 of FA 2004, landscaping. Does the planting of trees and shrubs qualify as landscaping? I don't know the first thing about gardening, I'm afraid. I apologise, but I don't. So I have no idea whether planting trees and shrubs counts as landscaping. And as a VAT consultant, that's problematic. So what's the resolution? Well, landscaping isn't defined by the VAT law. So therefore, it takes on its ordinary English meaning. So what I did was to look it up in the dictionary. What is the meaning of landscaping? And if you look up in the dictionary, it says, blah, 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 blah. including the planting of trees and shrubs. So planting these trees and shrubs is landscaping. Landscaping is a construction service. It's not zero rated because planning consent isn't required. So we've got subcontractor, main contractor, VAT registered, main contractor registered under CIS, service which is ordinarily standard rated. And again, the construction company is going to be passing on the costs to its end user. And therefore, it falls fully within reverse charge. So reverse charge should be applied on the subcontractor's invoice. That's the kind of thought process that one has to go through to arrive at whether it should be reverse charge. Now, subcontractors probably wouldn't be able to get through that. They wouldn't go through that process. Fortunately, if subcontractors work for large main contractors, the main contractors tend to self-bill on behalf of the subcontractor. So the main contractor goes through the thought process for the subcontractor. But it's worth noting with self-billing that if the main contractor makes a mistake, that is treated as the subcontractor's error. And it would be the subcontractor that will be liable for any penalties as a result. So self-billing makes it easier for a subcontractor, but they are reliant on somebody else to get their VAT affairs right. And if they get it wrong, the comeback is on the subcontractor. Sandra, excellent question. And Nicola, I will come back to your question. I apologise, but I will come back to it at some point. If a contractor registered for flat rate scheme and they receive an invoice from a subcontractor subject to reverse charge, how do they deal with it? They deal with it outside the flat rate scheme. They have to deal with it as a proper reverse charge invoice. So they don't count it as part of their flat rate scheme. That's the answer. So they have to account for output VAT and input VAT on it in the normal way. Okay. So the issues for the subcontractor in deciding whether reverse charge applies, I'm not going to go through it because it just goes through those 5 conditions that we saw earlier. But they perhaps ought to consider whether they should check that the main contractor actually is VAT registered, because a lot of people claim to be VAT registered and are not. And you can check someone's VAT registration number using the government's search service. Now, the other question to answer for the subcontractor is whether the main contractor will be passing on the cost to an end user. So what if you're a subcontractor and you write to me and you, because I'm your main contractor, and you say, can you confirm whether you are passing on this charge to a third party? And I don't bother writing back to you because I'm too busy, or I can't be bothered. It's below my pay grade. So I don't reply to you. What do you assume? Well, HMRC says that contracts between the subcontractor and the main contractor, they seem to assume they're going to be detailed contracts all the time, should be worded such that the subcontractor will charge VAT unless the customer tells them that they'll be recharging it. But that isn't what the law says. The law says that the subcontractor is to assume that their customer is going to be recharging this cost unless their customer specifically tells them to the contrary. So the presumption is that reverse charge arises. That's the presumption. Now, what about the main contractor? I think that in domestic reverse charge terms, it's the main contractor has far more to worry about than the subcontractor. The main contractor has to first of all ask the question, has the subcontractor charged us VAT? And if they have, should they have? Because if they've charged us VAT and they shouldn't, we have no right to recover it. You can't recover VAT that's been incorrectly charged. Okay, you can't recover VAT that's been incorrectly charged. By the way, somebody earlier asked me for the reference for the contents of a VAT invoice. It's in these general VAT regulations, and it's paragraph 14. Okay, paragraph 14, just to give you the full reference. So, has the subcontractor charged VAT? If so, should they have done? Because if the supply should be within the scope of reverse charge, they shouldn't have charged us VAT. We have to reject the invoice and ask them to issue another one that's reverse charge. So challenge the invoice, by all means settle the net amount, but don't pay the VAT if you don't think the VAT should have been charged in the first place. If they haven't charged VAT, there's probably 3 reasons why not. 1, the subcontractor isn't VAT registered, so they shouldn't be charging VAT. 2, it's a new build of a house, for example, so their supply is 0 rated. They shouldn't be charging VAT anyway. In both those first 2 cases, there is nothing for the main contractor to do apart from record the invoice and pay it. There's no VAT to worry about. But if it should be reverse charge, then they have to make sure it's correctly reported within the accounting system. Now, if they're using one of these new sexy accounting systems like Xero, QuickBooks, Sage, whatever it is, then they can just give the transaction a VAT code of domestic reverse charge, and the software works its magic in the background and gets on with it. But if they're not using that kind of sexy software, most people will be for VAT compliance, for MTD compliance. But if they're not, they have to make sure that whatever they are using puts the stuff in the right boxes. And for domestic reverse charge, the boxes that are relevant, you just have to think of snooker. Because the boxes that are relevant are put the output VAT in box 1, the input VAT in box 4, and the purchase amount in box 7. For those of you who don't follow snooker, 147 is generally accepted as being the highest break that you can make ordinarily in a game of snooker. I think technically it can be 155, but that's something for a different day. If you have a course on snooker, I'm sure that'll be covered then. Where we receive international services, so for example, you're watching this via Zoom today. We have a Zoom account. This is not our account, but we have a Zoom account, and we get invoiced by Zoom every month, about 44 quid a month. We've given them our VAT number, so Zoom knows we're VAT registered. Their supply of international services takes place in the UK for VAT purposes to our company. So we have to enter that in our accounting system as an international reverse charge. We have to account for the output VAT ourselves, which we can then recover as input VAT. Now, where it's international reverse charge, as well as putting entries in box 1, output VAT, box 4, input VAT, box 7, the value of the purchase, it also has to put an entry in box 6. Because for international reverse charge, we are treated as if we sold that service to ourselves in the UK. So it's subtly different for international services. Don't get too stressed about it. Getting box 6 wrong isn't technically a big deal, because box 6 is basically a statistical box. It doesn't affect the VAT due. If HMRC does an inspection and says, your box 6 number's not right, you should include this, this, and this, they'll just tell you to get it right going forwards, in which case you doff your cap, sorry, sir, and you do it properly going forwards. Desi, sorry, I do apologize. Desi, you asked a question quite some time ago now. I got carried away. So if we have a new build and the contractor is VAT registered, but the owner is not, how can the VAT be claimed back on the new build, or is the new build exempt? Well, there's quite a lot to unwrap in that, Desi, unfortunately. I presume this is new build residence. I presume it's a dwelling, in which case it's not exempt at all. It's 0 rated. So, okay, what's going to happen here in the supply chain? The builder is going to build the house. So the builder, if they take on subcontractors to do the services, that's going to be pretty much all 0 rated supplies they're receiving. But if the builder goes and buys bricks and mortar and other building materials and goods that are ordinarily installed in buildings like boilers, radiators, bathrooms, etc., fitted kitchens, then they will incur VAT with the builder's merchant, and the builder will recover that VAT. When they invoice the customer for the new home, 0 rated supply. Okay, what the law says is the first granting of a major interest in a dwelling after it's been completed is 0 rated. So if they sell the freehold to the new customer, or they grant a lease to the new customer exceeding 21 years, or for those who are in Scotland, excuse me, exceeding 20 years, then they make a 0 rated supply. So the customer doesn't pay VAT on a new home. Nicola, what I'm going to do is to look at your example at the next break, and I'll come back to you straight after that, if that's okay. If the owner purchased the material, then the owner suffers the VAT, and tough. So it's not very clever. Yeah, they should always get the builder to buy the materials, and they get the builder to invoice them, because then there's no VAT being recharged. unless, by the way, Desi, unless the owner is self-building. Because if you self-build your own property, then you can recover the input VAT via a different sort of system where you just make a claim within 3 months of it being finished, make a claim, you get the VAT back. I'm going to skip over end users, if that's okay for now. Let's got other stuff to cover, and intermediate suppliers and the example. My pleasure, Desi. Now, I'm not going to cover this because this is dangerous. But HMRC says that as a concession, in certain situations where an invoice contains a mixture of reverse charge services and non-reverse charge services, then you can treat it as a non-reverse charge invoice if the reverse charge element is no more than 5% of the total. That's a concession. It's a really dangerous concession. What the law says is that if you've got a mixed invoice and £1 of it is reverse charge, then it should be a reverse charge invoice. That's a much simpler rule. That's hard to get wrong. If any element of the invoice should be reverse charge, the whole invoice is reverse charge. HMRC thinks they're being generous by giving this concession, but this would require all subcontractors to become mathematicians. And they're not very good at that, most of them, and wouldn't want to get involved in that. So all I'll say is there is this 5% disregard concession. Can you please disregard this disregard concession? Because it's dangerous. It's seriously dangerous. So I'll leave the slide for you to read in your own time, but it's really dangerous. Okay, other land and buildings transactions, some of which I've touched on already with a question towards the beginning of the course, and also what I just discussed a bit before when Desi asked her questions about a home. A lot of people get really freaked out about VAT on land and buildings. No need to. It's all in the law. It's all written in the law. It's all written very nicely in the law as well. I said earlier that VAT ratings for land and buildings can be 0 rated, 5% rated, standard rated, exempt, outside the scope. We've got schedules that cover all of that. So Schedule 7A of the VAT Act covers reduced rated supplies, 5% rated supplies. Schedule 8 covers 0 rated supplies. Schedule 9 covers exempt supplies. Schedule 10 covers the option to tax. So you've got 7A, 8, 9, and 10. It's all in the same part of the law. Just keep flicking the pages over, you come to it. And it's not the whole schedule. It's a group of each schedule. So it's pretty well contained. Just don't be frightened of it. Most importantly, don't bring any baggage to it. In other words, don't bring any misconceptions that may have built up over the years. Read the law and just do what it says. And for goodness sake, don't try and use common sense or logic, okay? Because they don't work in VAT. My wife assures me the reason why I'm very good at VAT is because I have no common sense. So it comes easy to me. If you try and use common sense or logic, it simply doesn't work. Read the law and apply it. And I'll show you exactly what I mean by that as we go through this section. So the VAT law, when it comes to land and buildings, applies to the grant of any right or interest over land, or indeed to any license to occupy land. For all intents and purposes, for VAT purposes, a license to occupy is treated like a lease. Okay, I know in legal terms it's different, but in VAT terms, it's treated the same. Now, HMRC has tried to argue that if I have an option to buy land, or I have an option to sell land, that doesn't count as a land and building item. It obviously does, because I hold a right over land. An option to buy land, an option to sell land is a right over land. And the courts have always dismissed any arguments that HMRC have put forward, saying that it's not a land and buildings transaction, so it should be somehow treated differently. Now, the golden rule of land and buildings VAT, nothing else, just land and buildings VAT, is that if the law doesn't specifically mention the VAT rating of a land and building transaction, it is exempt. It's exempt. Because unusually, the VAT law tells you exactly which land and property transactions are standard rated. It doesn't for anything else, but it does for land and property. How do we know that legal fees, how do we know that accountancy fees, how do we know that consultancy fees are standard rated? Because they don't appear on the list of things that are exempt 5% or 0 rated. So by default, they're standard. In land and property, no. They tell you what's standard rated, and the default is exempt. If you know that piece of law, you're a long way to getting VAT on land and buildings correct. So what we do is check whether the supply is 0 rated. That's always the first place we look. Schedule 8 of the VAT Act. Schedule 8. That can only ever apply when it comes to land and buildings to dwellings, flats, houses, bungalows, residential purpose properties like care homes or boarding houses at school or army barracks, or if the building is to be used exclusively for a charitable purpose. It's only those types of property that could ever have some kind of 0 rating associated with them. Commercial property, never. Anything to do with commercial property can never be 0 rated. And specifically, 0 rating of these properties only applies to construction of them and the first grant of a major interest. And that is a single phrase. The first grant of a major interest, essentially, once the property has been completed. Okay, once the property is complete. And a major interest, as I mentioned before, is either the first sale of the freehold after it's been completed, or the first granting of a lease that can last for more than 21 years. In Scotland, it is 20 years, more than 20 years. Note, more than 21 years, not more than or equal to 21 years. Now, let's say, and it might be fairly topical at the moment, let's say that you act for a property developer. They have built a new house, always with the intention they were going to sell it once it was finished. So if they're not registered already, they're registered for VAT. They've claimed back any input VAT that they've incurred during the construction phase. That won't be on the building services, because the construction services provided by subcontractors will be 0 rated. But they might have incurred VAT on lawyers' fees, getting planning consent, professional fees like architects, surveyors, they're specifically standard rated, and on building materials, the builder will be charged VAT. Now, the house is now finished, and they did want to sell it, but the market's dropped quite considerably because of increasing interest rates. So they decide they're going to rent out this property for, say, 3 years, pending, hopefully, an increase in the market price later. So renting out property is not mentioned explicitly by the VAT law, which means that it's an exempt supply. Yeah, it must be an exempt supply. So they're going to rent out the property for 3 years. And then the intention is that after 3 years, they are going to sell it. They believe the market will have recovered by then, and they're going to sell it. So 3 years later, let's assume they sell the house. What is the VAT rating of the sale of the house? What's the VAT rating of the sale of the house? It's been rented out for 3 years, having been finished, and it's now being sold. The freehold's now being sold. What's the VAT rating? If you want to type some answers into the chat or into the Q&A, the answer will either be 0, exempt, standard, or reduced rate. So you can type 20, 5, 0, or exempt. What do you reckon? An offer of exempt in the chat. Thank you. I've got exempt in the chat, exempt in the chat, exempt in the chat, exempt in the chat. Standard. Thank you, Helen. Standard. Okay. Right, stop. That's fine. Thank you. Oh, we've got one offer of 0, one standard, lots of exempts. Okay. This is what I mean by not carrying baggage into this and just reading the law. The property was finished, and since it was finished, a 3-year lease was granted. Is that a major or a minor interest? Granting a 3-year lease, is that a major or a minor interest? Please just type major or minor. Yeah, everybody agrees it's minor, yes? Why? Because it's not more than 21 years. Thank you. Yep, you can stop now. Perfect. Thank you very much, Lee, for playing. I appreciate it. Really appreciate it. So when they sell the freehold 3 years later, is it or is it not the first grant of a major interest once that property has been completed? It is. Because all they've done before is to grant minor interests. So when you make the first grant of a major interest, it is a 0 rated supply. The answer is 0, not exempt. Helen, you cannot standard rate the sale of a house. You can never standard rate it. So yes, it's 0 and not exempt. If you read the law and just follow what it says, you get the right answer. I don't care whether it makes sense. That's not important. You get the right answer. My pleasure. Now, assuming that the supply doesn't qualify for 0 rating, Maxine, extension of residential lease. Lease extensions are not mentioned by the VAT law. So what do you say? You can answer this. Lease extensions are not mentioned by the VAT law, so what's their VAT rating? No. Read the second bullet point of my slide, please. Read the second bullet point of my slide and then re-answer the question. Thank you. It's exempt. 0 rating only applies to the first grant of a major interest. Maxine, if you're talking about an extension, that can't be the first grant, can it? So it can't be 0 rated. Do you understand the logic? Sorry, not the logic. You understand how I'm interpreting the law. Okay. There's only very, very specific, limited transactions that are 0 rated. Okay. Superb. Thank you very much. Thank you. Excellent. And by the way, whilst you are allowed to opt to tax a residential property, it has no effect whatsoever while it's residential. You can never, ever charge VAT on a residential property. Not allowed while it's being used or it's available to be used as a residence. Okay, so if it's not 0 rated, the next thing we have to check is whether it is 5% rated. Yeah, correct. Yeah, you never charge VAT on a residential property. Correct. Yeah, correct. Check if it's reduced rated. Check if it's reduced rated. If it's not standard rated. Now, I'll talk about 5% rating a bit later on, but it only applies to very, very specific supplies of services by a builder, either carrying out a qualifying conversion or a qualifying renovation. But I'm going to talk about it in a bit more detail shortly. If it's not 0 rated or reduced rated, the next thing you check for is whether it is standard rated. Schedule 9 of the VAT Act, Group 1, tells you which land and property transactions are standard rated as of right. I mentioned earlier, somebody asked a question, I mentioned earlier, that a commercial building that's being supplied either part complete or within 3 years of being completed is a standard rated supply. The construction of a commercial building is a standard rated supply. What if the building is being sold after 3 years from being completed? Well, the law doesn't mention what happens in that situation. So if a building is being sold more than 3 years after it's been completed, then by default, it is an exempt supply. Okay, just like residential properties can never be standard rated, commercial properties can never be 0 rated. They'll either be exempt or they'll be standard rated. So you have to know that there is this option to tax in Schedule 10 of the VAT law. Then if the person who is making the supply has opted to tax their interest in the land and buildings, they charge standard rated VAT, even though by default that transaction would ordinarily be exempt. So a question come in, if a VAT registered builder is building an extension to existing residential, should they charge VAT? I haven't covered that actually yet, Desi, but I will cover it. Specifically, the law says that repair, renovation, enlargement, and conversion services are standard rated unless they're covered by a 0 rating or 5% rating specifically. So extending a property is a standard rated supply. Doesn't matter what the property is, it's a standard rated supply. The only exception would be, I think, if the extension was part of a renovation which qualified for 5% rating, which we're going to look at momentarily. So that's just almost like a one-page summary of how VAT applies to land and buildings. There's obviously much more to it, but that's like a one-page brief summary. Now, I try to stress to people that HMRC's guidance is just that, and it's not the law. And sometimes the guidance contradicts the law or doesn't say what the law says. So I'm not going to go through this in detail, but just to point out one example, Schedule 8 Group 5 says that 0 rating applies, Schedule 8 0 rating, to a supply in the course of construction. So you must be in the course of construction. The property's not finished yet, in other words, of a building designed as a dwelling or a number of dwellings. So let's just focus on that one. Don't worry about the rest of it. Of any services related to the construction, related to, that's the phrase, related to, other than the services of an architect, surveyor, or a consultant acting as a supervisor. They're not 0 rated, so they would take on their normal VAT rating, which would be standard rated. Don't worry about housing associations, not important here. And the supply of building materials to a person to whom the supplier is supplying services. So if a builder is supplying me with construction services to build a new dwelling, and they also supply me with the materials, they buy the materials, and that's part of the supply, then the 0 rating applies to them invoicing me for the materials. That's what number 4 is saying. Now, HMRC says in its notice 708 that your service, it's to builders, it says your service is supplied in the course of construction when you carry out work on the building itself, including applying any usual decorative features prior to completion. I don't disagree with that. And then any other services closely connected to the construction. Closely connected to the construction. The law doesn't use the term closely connected. It uses the term services related to the construction. And those two terms are nothing like each other. And the impression I get is that HMRC's guidance seems to be trying to narrow the possible services that qualify for 0 rating. Our job is to comply with the law, not with HMRC's notice. And I spend a lot of my consultancy time arguing that with HMRC, that their guidance is not the law. In fact, when they write to me saying our notice says this, I write back very politely, because I'm a very polite fellow, I reply very politely and I say, thank you for the letter. Can you please quote the relevant legislation, please? I'll talk about, I'm not talking about your notice. I don't care about notice. I don't take that, but that's what I mean. Can you please send me the legislation reference and we'll talk about it. I won't enter into any discussion with HMRC about their notices unless the notice benefits my client, in which case I will embrace it fully. But if it seems to narrow what the law says, I will go back to HMRC and say, no, let's talk about the law instead. Okay, goods ordinarily installed in new dwellings covers things, sorry, goods not ordinarily installed in new dwellings. I talked about fitted wardrobes earlier. It also covers things like carpets and things like, I don't know, TV, sound systems, yeah, that sort of stuff. If a contractor is invoicing a developer, then the contractor would ordinarily charge 20% VAT, although reverse charge might apply, domestic reverse charge might apply to that situation. But if the developer then charges the intended homeowner, the buyer of the property, the ultimate buyer, then the developer zero rates it as part of the overall supply they're making. So I answered the question earlier and said that a new homeowner should never, ever be charged VAT for the cost of the property, even if the property includes things like tables and chairs, TV, fitted wardrobes. The developer should never charge VAT. The way that HMRC gets its money is by saying to the developer, you zero rate your supply to the end customer, but you cannot recover the input VAT that you've been charged by builders for goods that are not ordinarily installed in new dwellings. Now, that is affectionately referred to in the UK as the builder's block. But actually, it's a bit of a misnomer. It should probably be called the developer's block, because the builder would either charge that or certainly reverse charge, and the developer wouldn't be able to recover any input VAT related to that supply of goods. But the homeowner, the individual, you and I, we should never be charged VAT when we buy a brand new home. Whatever's in it, we shouldn't be charged VAT. Right, I think we'll stop for our second break at this point. Let's come back, please, at 11:10, and we'll pick things up from there. I do want to try and get through the land and property stuff more quickly than I otherwise would, bearing in mind there's bound to be other questions, because I do want to talk about supplies, cross-border supplies of services. And that helps to back up an answer I gave earlier about immigration law services being provided. So back at 10 past, we'll pick things up from there. Welcome back. Nicola, I did drop you a quick chat. You sent me an example in the Q&A. Is it okay if I share that example with everybody in the chat so they can all see the numbers that I'm talking around? Sunil, you mentioned, or you asked a question, if the extension is part of renovation, it could be classified as zero rate. I didn't say that. If you play back the recording, I definitely didn't say that. I said that if the extension is part of a qualifying renovation, it might be 5% rated. And you said, can I provide a link to guidance to understand what is classified as a renovation? Answer, no, I can't. The law, Schedule 7A, just talks about a renovation, a qualifying renovation. It doesn't define renovation. So my link would be to the Oxford English Dictionary as to what renovation means, and then work out whether that's what's going on in a client situation. So Nicola, can you let me know whether I can share the example with everybody? If you're still with us. There you are. Okay, until you answer, Nicola, I'm not going to cover the example, okay, because you may not be... there you go. Perfect timing. Okay, thanks very much indeed. Appreciate it. So this was an example earlier I was given about mystery shoppers, and I expressed some possible concerns with it. So the example is now in the chat, so you can all read it, because it's quite a long example. So it sounds like your client or you act as a mystery shopper on behalf of a restaurant. So I suppose you give them feedback as to how well people were served. So the shopper is not an employee. So they go and eat in the restaurant, and the receipt shows food gross 130 plus a tip of 13, so 143. There's input tax on the food of £21.60, 1/6 of 130, but the tip, I presume the tip was voluntary. It wasn't a mandatory tip. If there's a mandatory service charge, then the VAT just follows the same rating as the meal. So when we pass on the disbursement, I wouldn't call it disbursement, by the way. That's a dangerous word to use right now. But when you pass on the cost on the sales invoice, you claim the net on the food of 108.30 plus the tip of 13, and then calculate the output VAT of £24.26, which I presume is 20% of 121.30. Yeah, 24.26. Okay, now there's quite a lot to unravel here. Obviously, the restaurant receipt doesn't actually have the name of the customer on it. And the problem is that your client, or you as the mystery shopper business, didn't actually eat in the restaurant. Somebody else did who's not an employee. Technically, the restaurant has made a supply to them, and they have made an onward supply to you. Now, we could probably argue that the input that you've incurred, the cost you've incurred, and therefore the input VAT that's been incurred is directly related to the output that you have made. So we probably could resist a claim from HMRC that input VAT can't be recovered. So I think you probably could recover it. When you pass on the cost, which I presume must be to the restaurant, I presume that's who you're mystery shopping for, unless you're mystery shopping for somebody who rates restaurants, then yeah, the £13 is not a disbursement, because that's an amount that you have incurred, not your customer. And therefore, when you pass on the charge, you charge VAT on the whole lot. So I do think your output VAT is correct. The input VAT, I think HMRC might ask a couple of questions if they found out what was happening, on the basis that the company itself, the business itself, is not incurring itself that input tax. But it's clear that the input is directly related to the output. It's a cost component of what you're selling. So I would have thought that even if they raised it as an inquiry, it could be defended, but it might require a bit of time to do that. Okay, let's move on. Relevant charitable purpose. We were talking about zero rating before, and I said that if a property is being used for a relevant charitable purpose, then the construction of the property, the first grant of a major interest in the property, would be zero rated. That's relevant charitable purpose is defined as use by a charity, either otherwise than the course or furtherance of a business, or as a village hall or something similar, in providing social or recreational facilities for local communities. Now, the reason why they're kept separate is because normally something is in the course of business, even if you're a charity, if you charge for the service as a way of trying to raise some income for the charity. So let's say that you act for a charity, you work for a charity, and the charity is having a centre constructed where lonely people, homeless people can come and use the facilities, keep warm, meet other people, have a drink if they want. And you're having that constructed as a charity to further your charitable aim. You're not profit making, you're a charity. Now, if you charge the people who use your facility, let's say you charge them £1 a day or £2 a day as a way of just generating some extra income for the charity, it doesn't cover the costs of running the centre. You've got to rely on grants and donations to do that. You are charging people for the service that you are providing to them. You're not going to make a profit out of it, charging them, but there's a charge. So that would be treated for VAT purposes as a supply in the course of a business. And that would mean that the charity cannot get the construction of that centre zero rated, because they're essentially running a business for VAT purposes from it. It's treated for VAT purposes as a commercial building. And I told you earlier that the construction costs of a commercial building have to be standard rated. However, if what's being built is a village hall or something similar to a village hall, and it's designed to provide social recreational facility for the local community, then the charity can charge what the hell it likes, and it won't interrupt the zero rating of the construction of that village hall. So the only debate is whether what's being built is actually a village hall or something similar to a village hall. And there's many cases that go on about that. To me, a village hall is generally a fairly bland open plan, normally single-story building that has a bar or a catering, a food area as part of it. But it's generally a blank canvas. a multi-storey building would not be a village hall. A very large, grand building would not be a village hall. But what is a village hall? It takes on its ordinary meaning, and that's a matter of interpretation in many cases. So the next slide talks about charging notional fees, just like the £1 or £2 I talked about earlier, for people using the centre. Case law tells us that if a price is charged by a charity for people to use its services, even though it's a nominal price and it doesn't cover costs, generally speaking, that is a supply for VAT purposes, if the charge is made as a way of generating at least some income for the charity to oppose some of its costs. Developers, going back to developers, I gave you the example earlier of a developer who had completed a house, wanted to sell it, markets dropped, they rent it out for 3 years, minor interest, and then later they sell the freehold, 0 rated. The problem is that when they constructed the house and incurred the legal fees and other fees, they assumed they were going to sell the property straight away. So they registered for VAT, they claimed back all of the input VAT they'd incurred immediately because they were expecting to make a 0 rated sale. And they didn't. They ended up renting it out for 3 years, which is an exempt supply, and then they sold it as a 0 rated supply, which essentially makes them partly exempt. They made some exempt supplies and then a big 0 rated supply at the end. So the one question to ask is whether they have to pay back any of the input VAT that they claim back on the way through. And the answer is possibly. It all depends. Yeah, it all depends. Now, let's just take a slightly different scenario. What if I've built a block of flats with the express intention on day one, I'm going to rent out those flats when it's finished? What is the VAT rating of renting out residential accommodation? Is it 0, exempt, 5, or 20? Renting out residential accommodation. 0, exempt, 5, or 20? Thank you, Kashif. Offer exempt. Offer of 0, exempt. Thank you, Maxine. Yeah, some are saying 0, some are saying exempt. Please remember, 0 rating is very specific. It's for 2 transactions: the construction of a dwelling and the first grant of a major interest in a dwelling. That's it. 2 supplies. Otherwise, anything to do with residential property is going to be largely exempt. Certainly renting out is exempt for sure. So it's an exempt supply. So I'm building a block of flats that I'm going to rent out. And that's an exempt supply. So basic law would tell me I can't recover the input VAT that I incur, the professional fees, the building materials. Again, constructing the flats, somebody's constructing dwellings. If they invoice me for constructing dwellings, it's 0 rated. But professional fees and building materials, standard rated. But if I'm going to rent out, then in theory, I'm only making exempt supplies. I can't even register for VAT. So I can't claim back the input VAT. There is a very easy solution to that problem. As long as your clients are willing to use a corporate structure. They create a development company, which develops, which builds the flats. And then when the flats are complete, you then create a wholly owned subsidiary of that development company, and you grant a 22-year lease of the flats to the second company, the investment company, let's call it. The grant of a 22-year lease of recently completed flats is going to be a grant of a major interest, but a grant of a major interest, and therefore 0 rated. So the development company makes a 0 rated supply to the investment company. So Development Co can get all its input VAT back. Investment Co hasn't paid any VAT. It doesn't have to pay SDLT because there is a specific exemption for intra-group transactions, 75% group transactions. And it can now rent out those flats and it hasn't paid any VAT in the first place. So the group as a whole gets the VAT back. It's a very, very simple piece of VAT planning, which is actively endorsed by the government. The government wants recovery of input VAT when people build new housing stock, because as a social policy, it's very helpful indeed. Now, when it comes to an individual, let's say, that's built a property intending to sell it, but faces a market downturn and has to rent out instead, then we've got to think about input VAT recovery in that context. Let's assume they only build one house a year, because partial exemption is done on an annual basis. And during that year, they incurred input VAT of 22 grand on this house. They now intend to rent it for 3 years, pending recovery of the market, and then sell it. So how do we work out whether they owe any input VAT back to HMRC? Answer: we use a combination of the capital goods scheme, which relates specifically to certain property, and the normal partial exemption rules. Now, I don't want to go into great detail about the capital goods scheme today. We just simply don't have the time to do so. Then the only thing I'm going to mention about the capital goods scheme, other than the question I answered earlier, is that the general thrust of the capital goods scheme is that you judge input tax recovery on a property over a 10-year period. So that if the use of the property changes over that 10-year period, there can be an adjustment to the input VAT that was originally claimed. Hence, why if you buy a commercial property and you recover the input VAT on day one, because you're using it to make wholly taxable supplies, and then 7 years later, somebody gave an example earlier, you sell it as an exempt supply, then there is a clawback of 3/10, because it's a 10-year adjustment period. And if you sell it as an exempt supply, it's treated as if you were going to use it for exempt purposes for the remaining 3 years of the 10-year clock, the 10-year window. So you have to pay back 30% of the input VAT. So we kind of use that approach here and say that they're intending to rent out the property for 3 years, which is an exempt supply. So let's take 3 years of exempt supply out of a total consideration period of 10 years. So 3/10 of the input VAT is 6,600. We then say, is that de minimis under the partial exemption rules? Well, the partial exemption rules broadly say that if the input VAT on the exempt side is under 7.5 grand a year, £625 a month on average, 7.5 grand a year, and it's less than half of the total input VAT, you can keep it. Well, mathematically, I hope you understand this, but mathematically, as long as this number here, this 3, as long as that number is less than 5, then the input VAT on the exempt side is less than 5/10 of the total. It's less than 50%. So here, the input VAT is on the exempt side is 6.6 out of 22 grand. That's less than half, and it's under 7.5 grand. So under this example, we wouldn't have to pay back any input VAT. We can keep it. It's de minimis. But if the numbers were larger, Sandra, I'll come back to a question in a moment. If it's larger, then we may have to pay back some VAT. So assuming that a client builds 2 houses a year, both intending to be sold for 500 grand, £500,000 each, and the input tax recovered in the year was 50 grand, again, the market's dipped. So although the house builder was intended to sell, they now are going to rent out for a few years before they sell, so the market can recover. Let's just, again, just assume for simplicity, it's 3-year rental is the expected rental period. And they expect to generate 200 grand of rent during that period, so exempt income. Using that same approach of taking the letting period divided by 10, 3 divided by 10 of the input VAT gives you exempt input VAT of 15 grand. That is not de minimis. It's above 7.5 grand for a start. So therefore, there will be a clawback of some of the 50 grand input VAT. And we simply use the standard method of partial exemption recovery, which is to take the exempt income as a percentage of the total income. Except the only thing here is, this is all done before the property is actually rented out. It's done when you change your mind, you change your intention. I was going to sell, I'm now going to rent. That's when you do this calculation. So it's based on budgets, it's based on forecasts. As long as they're reasonable, HMRC cannot disturb them. They can't true them up later. So we would say here that we were expecting reasonably to get 200 grand of rental income over 3 years, and then we were expected to sell the houses for £500,000 each, £1 million in total. So the clawback is pro rata 200 grand to the £1 million of zero rated revenue we expect to generate in 3 years' time. So the clawback is 200 exempt sales divided by 1.2 million total sales multiplied by the input VAT in total. So the client would have to pay back 8,334 of input VAT, and that would be the end of the story. Even if after 3 years, they then couldn't sell the properties for 500 grand because the market hadn't recovered, and they decided to rent them again for another 3 years, doesn't matter. It doesn't matter. This calculation is final as long as the assumptions used were reasonable at the time. By the way, Sandra, I haven't got that. I will come back to you. What would happen if, let's say, your developer client has built houses to sell, market's dipped, they rent them for 3 years. After 3 years, the market didn't recover. So they rent them for another 3 years, market didn't recover, another 3 years, another 3 years, another 3 years, another 3 years, another 3 years. Before you know it, they've granted 10 3-year leases on this property. It's now 30 years old. Finally, the market recovers, so they sell the freehold. What is the VAT rating of that sale? In 30 years' time, what is the VAT rating of the sale of the freehold? It's a residential building, so it can only either be zero rated or exempt. Offer of zero. Thank you. Offer of exempt, offer of zeros. Most people are saying zero, some people are saying exempt, which is fabulous. Normally, everyone says exempt. Exempt is incorrect. Read the law. We've granted 10 3-year leases. Are they minor or major interests? 10 3-year leases. Is that 10 minor or major grants? Minor. So when we sell the freehold 30 years later, it is the first grant of a major interest since the house was finished. The first grant of a major interest is zero rated. You may not believe it, it may not make sense, but it's what the law says. Is that understood? You've got to just read the law and apply. Now, some of you may have forgotten the law, that's fine. I only just told you about it like an hour ago, but once you read the law, just apply it. Don't think about it, just apply it. If you said zero, fantastic, well done. That's excellent, really excellent. 5% rating. 5% rating for property transactions. Again, it's only building services that qualify for 5% rating, including the materials that the builder may supply as part of that project. Has to either be a qualifying conversion or a qualifying renovation. So whoever asked the question, I can't remember who, I apologise, about what the definition of a renovation, you'll find out that from conditions, it doesn't really matter. You'll work it out. So there are 3 flavours of qualifying conversion. Number 1, a change in the number of dwellings conversion, which is what I call the Ronseal category. For those of you who remember Ronseal, it does exactly what it says on the tin. If you carry out some conversion work and that changes the number of dwellings within the property, and there's at least one dwelling at the end, that is a change in number of dwellings conversion. So a barn conversion is one of these, because it goes from no dwellings to 1 dwelling. Converting a house into 2 flats, qualifying conversion. Converting 2 flats back into 1 house, qualifying conversion. It's a change in number of dwellings, not necessarily an increase in the number of dwellings. Secondly, converting a house into a house in multiple occupancy, an HMO. The work to do that is 5% rated. And frankly, converting any building whatsoever into a care home or other relevant residential accommodation, like a boarding house or army barracks, but normally converting anything to a care home, converting it is 0 rated. I am talking about conversion, not demolition and reconstruction, conversion. Now, there are certain conditions to meet. It's got to be done lawfully with planning consent and so on. Unlawful building, by the way, unlawful building, standard rated, always. If somebody is building without necessary planning consent, then that is standard rated, whatever they're building, whatever they're doing. Now, there's been a couple of cases gone through the courts many, many years ago. In fact, each of the cases had to go through 3 courts to get a definitive result. I don't think they need to. So here we got before a pub on the ground floor. On the first floor, 1 flat that gets converted into 2. And on the top floor, nothing much happens. So one assumes that in the top floor, nothing really went on particularly. What is the VAT rating of the work done to convert from before to after? Is that a qualifying conversion? Yes or no? Is it a qualifying conversion? Yes or no? An offer of yes. Thank you, Jeff. Quite a few offers of yes. Thank you very much. It is. Why did it take 3 courts to work this out then, if you got it all in about 10 seconds? Okay, thank you. You can stop now. Everyone's saying yes. That's fabulous. Why is it a qualifying conversion? Quite simply, we changed the number of dwellings. The only question to answer really, do you work on a building by building basis or on a floor by floor basis? Now, even if we go on a floor by floor basis, which HMRC always argues, the ground floor wasn't a residential dwelling before, and it is afterwards. So that's changed the number of dwellings. The first floor was 1 dwelling, it's now 2 dwellings. So that's changed the number of dwellings. So the first and second floor work is definitely 5% rated. Now, if the third floor was a flat before and a flat afterwards, then no conversion work's been done. And therefore, technically, the amount allocated to the third floor, if anything's done on the third floor, wouldn't qualify for 5% rating. But largely, it would be 5% rated. Sorry, Sanjar, I'm going to come back to your question. I do apologise. So if a building has both commercial unit as well as residential, and the managing agent charges VAT to manage the whole building, can all that be recoverable? Recoverable by who? The landlord, the owner of the building, yes? Well, the answer has to be no. It has to be no. Because if the agent is managing the whole building, then that's an input that relates partly to exempt supply of residential accommodation. And partly, I presume that the owner has opted to tax their interest in this building. So they're charging the commercial tenants VAT. So no, that agent VAT is what we call residual VAT from a partial exemption perspective. It's pot VAT, it's overhead VAT. It needs to be apportioned between both sides. And you can only recover the input VAT that relates to the taxable side unless the overall input VAT on the exempt side is de minimis. Is that clear? That's just normal partial exemption rules, Sandra. Yeah. Okay, what about this example? This example. What say you? Is this a qualifying conversion? Yes or no? Yes or no? An offer of no, 2 offers of no. In the chat, offers of yes. 1 offer of yes, 2 offers of yes. Okay, so a few yeses and a few no's. Okay, so I think we can argue, or we can say that there's a fairly mixed view about this one. So there are 3 types of qualifying conversion. I haven't mentioned HMOs and I haven't mentioned care homes, so it's all about number 1 here. Has there been a change in the number of dwellings? In this example, has the work changed the number of dwellings? Yes or no? Steve says no, thank you, twice, very good. No, thank you, Graham. Helen, you say it's changed the number of dwellings. How many dwellings were there before, Helen? How many dwellings were there? There was a shop. Is a shop a dwelling? So you would live in a shop, would you, as your home? If so, I can find you a charity that can house you properly. Yeah. A shop is not a home. Yeah. Yeah. Thank you, Alex. IKEA, you would. Yeah, absolutely. They wouldn't let you stay overnight. That's the only problem, IKEA. And you'd never find the exit afterwards anyway. The shop is not a dwelling. Yeah. That's okay. Don't worry. The shop is not a dwelling. You probably woke up in a shop, Helen. So the shop is not a dwelling. So there are 2 dwellings before, there are 2 afterwards. You haven't changed number of dwellings. It's not a qualifying conversion. So the work to go from before to after would have to be standard rated, because it's a conversion, but it's not a qualifying conversion. There's some very amusing comments, by the way, in the Q&A, so I'm not going to share them with you, but they're very amusing. Thank you very much for those who have said that. So do you understand? We haven't changed number of dwellings, not qualifying conversion. I said earlier, there's a specific law that says repair, renovation, conversion, enlargement, standard rated, unless it meets the conditions for a special rule. So if it's not a qualifying conversion, if it's a non-qualifying conversion, it has to be standard rated. So this is standard rated. Now, I can't remember exactly who asked the question about renovation. I apologise. A lot of people asked questions so far. But there's also qualifying renovations. And building services incurred in renovating a dwelling are 5% rated if the dwelling has been empty for 2 years. That's it. The building, the dwelling, has to have been empty for 2 years. Now, if your client is going to be developing that property as a business, then the only rule is that it has to be empty for 2 years at the time when the work begins. And people say to me, well, what does it mean by the work begins? Well, it doesn't say, so just ordinary meaning. When the workmen turn up for the first time and say, don't worry about a cup of tea, I want to crack on with the work. That's when the work starts. So you could buy a property that's already been empty for 18 months, a dwelling that's been empty for 18 months, and then not start work for a further 6 months. Well, then when you start the work, it's been empty for 2 years. You have to have proof it's been empty for 2 years. Obviously, HMRC will ask you for proof, but as long as you can prove it, you're home and dry. The builder should only charge you 5% VAT. Now, I mentioned earlier that if it is a qualifying renovation, so the project is 5% rated, the builder is actually allowed to build an extension as part of that qualifying renovation, and the extension takes on the same VAT rating as the renovation. The whole project is 5% rated. If you're buying this dilapidated property to be your home, there's a different condition. In fact, there's 2 conditions. One is that that dwelling must have been empty for 2 years when you bought it. And secondly, the building work has to be completed within 12 months. So what happens if it overruns? What if it overruns? Well, then the building work, retrospectively, is not 5% rated. And if it's not 5% rated, it must be standard rated, because renovation is generally standard rated unless it qualifies under a special rule. So who's going to pay the extra VAT? The homeowner or the builder? Well, that all depends on what the contract says and possibly the cause of the overrun as well. If it took more than 12 months because of COVID, then the contract may specify some sort of clause that says that if the overrun is outside the control of the builder, then any extra VAT payable gets borne by the owner. But if the overrun is within the control of the builder, then the builder bears that cost. So basically you'd have a fight. Yeah, you'd have a fight over who's going to bear the extra VAT. I talked about standard rated supplies earlier. Read Schedule 9, Group 1, and it will tell you which property supplies are standard rated. Andy, a question. If the builder uses subcontractors, do they charge 5% to the builder? That's a cracking question, Andy. So Schedule 7A, you need to read the schedule. It's Schedule 7A, and it's Group 7. Well, Group 6 and 7, but Group 7 is renovations. It says the supply in the course of renovation. In fact, what I'll do is I'm going to share this with you so you can see it. So it should pop up on the screen. You should see it now, actually. Yep. So the supply in the course of renovation or alteration of qualifying services related to renovation or alteration, and the supply of building materials, etc. Supply supply is only part within, so we make an apportionment, that's fine. Then it says, for the purpose of the group, alteration includes, qualified includes, what a building lasts. Okay. Item 1 and 2 don't apply unless conditions are met. That's fine. That's all to do with the 2-year period. Right. So we got a first empty home condition that neither the premise is concerned nor where both premises are part of a building that part was lived in during the period of 2 years ending with the commencement of the works. The second empty home condition, so we've got to meet one of those two conditions. So in the second empty home condition, it specifies that the supply must be made to a person who is, or yeah, one of the persons who's beginning to live in the property brought to an end of period mentioned in A, and the person who acquired the dwelling. So in the case of the second empty home condition, if a subcontractor bills the main contractor, the subcontractor would have to technically charge standard rate. But actually, Andy, they would have to reverse charge it now, wouldn't they? Because the main contractor is going to be recharging it to whoever the homeowner, the developer is, I guess. So in the second empty home condition, I'll leave you to read this in detail yourself, but in the second empty home condition, there is a condition that says that the supply must be made to the end party. So a subcontractor can't benefit from 5% rating. But in the first empty home condition, it doesn't mention that. So in that one, then the subcontractor could 5% rate. That's what the law says. Read the law, yes? Read the law. It tells you the answer. We don't have time to go through that empty home condition in great detail right now. That would be, bearing in mind all the other things I want to try and talk about in the last 15 minutes, I think that would be perhaps a little bit too much this time around. I apologise. Okay, let's go back to the slides. So standard rated supplies include the sale of a building that's new or within 3 years after completion, as long as it's not a dwelling or it's a charitable building or a care home broadly. Enhancing we talked about earlier. Vehicle parking facilities are standard rated. And we've, yes, vehicle parking facilities are standard rated. The only exception, by the way, is council on-street parking. So parking meters on street are not standard rated. Any other parking, any other vehicle parking is standard rated. Note, it doesn't just say car parking, vehicle parking. Now, what if you've gone back to your offices, but on a hybrid basis, and you have some spare car parking spaces you don't use anymore? And a couple of people approach and say, look, we've noticed you've got some empty car parking spaces. We want to run a car wash business using that space. Your lease allows you to sub-rent those spaces to them. Are you, and you haven't opted to tax your interest in the building, are you renting them space, which means that that will be an exempt supply, or are you renting them vehicle parking facilities, because that will be standard rated? This was the subject of a recent case. And if the lease says that you are renting them parking spaces, then you are renting them vehicle parking facilities. The fact they're not going to use it for vehicle parking, that's their problem. It's not yours. And therefore, standard rated. Yeah. If a farmer allows a haulage company to park their lorries on the farmland, and the farmer is VAT registered but hasn't opted to tax their interest in the land, it doesn't matter. They're charging the haulage company to park their lorries. They've got to charge them 20% VAT because the law says so. Renting out holiday accommodation. Somebody asked about FHLs earlier. Renting out holiday accommodation, not necessarily FHLs, furnished holiday lets, is a standard rated supply. And anything else to do with holidays is also standard rated. There are other standard rated supplies as well, like aircraft hangarage, boat moorings. Even though you're kind of renting a space in a hangar, or you're renting a mooring on a river, or on a river, that is standard rated because the law says so. The next slide talks about car washes, which I just gave an example of. And then finally, when it comes to property VAT for today, the option to tax. Okay, the option to tax. People don't understand it's a two-stage process. The owner of the property or the director of the company that owns the property has to consciously decide they want to opt to tax a property, and they have to notify HMRC of the option. Strictly, they have to notify within 30 days of their epiphany that they want to opt, but HMRC does accept late notification, but you cannot validly notify an option after the property has been sold. So if you said that you had decided to opt to tax a property, but you never notified HMRC before it was sold, then in the eyes of the VAT law, you never opted. Yeah, sure. Ildiko, with pleasure. If a farmer owns farmland and they're VAT registered because they sell lots of farm produce and they can recover input VAT, but they haven't opted to tax the farmland. If they rent out land on the farm generally, that would be an exempt supply because renting out is exempt generally because they haven't opted to tax. But if they rent out space for a haulage company to park their lorries, then they're making a supply of vehicle parking facilities. And that is explicitly standard rated in the VAT law, Schedule 9, Group 1. So yeah, so if they rent out the field as a car park for an event, then that should be standard rated. Correct. Correct. Pleasure. I'm going to skip over the rest of this slide. This example is worth internalising, though. This was based on a recent case. Let's say that a company bought a commercial building for £500 plus VAT. The vendor had opted to tax the property, so it might have been more than 3 years old, but the option to tax made the sale standard rated. The company claimed it had opted to tax, so it claimed back the £100 VAT in its VAT return. Apparently didn't notify the option to HMRC, and then a few months later received a surprise offer for the building, which they accepted, and they sold it to a third party for £600, and they charged VAT on it as well, because they said that they'd opted to tax. Now that brings out an important point about the option to tax, which is that just because a vendor opts to tax doesn't mean that a purchaser has to. Each person makes their own decision over whether they opt to tax. It's a personal thing. There's no such thing as a building having an option to tax over it. Now, it therefore charges its customer for the building £600 plus VAT, but it never notified the option to HMRC. So the option was never valid, okay? Never valid. But in the meantime, the company has collected the £120 output VAT from the client, the customer, and is prepared to pay it over to HMRC in its next VAT return. HMRC in that situation would be able to argue successfully that the company never opted to tax properly. It didn't meet the conditions because it never notified the option. So it means the company should never have claimed back the input VAT of £100 on the purchase, because having not opted to tax properly, the sale of that building, assuming it was over 3 years old at the time, the sale of that building should have been an exempt supply. So it should never have recovered the input tax because it never made any taxable supplies with the building. It made an exempt sale a few months later. So it owes HMRC the input VAT back, and bizarrely, it also owes the output VAT, even though it should never have charged the output VAT of £120. Any business that purports to charge VAT on an invoice owes that VAT, inverted commas, to HMRC. Schedule 11 of the VAT Act covers this. Showing VAT as an amount on an invoice creates a debt to the government, and you owe that money to the government. So that was a pretty serious mistake the company made by not notifying the option. Now, a question. What if a VAT registered business has an office in the back garden with no option to tax? As the company is not presently using the option, they rent it out to a husband's company. Should they charge VAT? Oh, Alex, you can answer that question yourself. The office is a commercial building. The owner hasn't opted to tax. So when they rent it out, what type of supply is it? You can answer this yourself, Alex. Give it a go. Almost the right answer, Alex. No. If you remember, I said at the beginning that unless the VAT law says otherwise, land and buildings transactions are exempt. I said earlier that the VAT law doesn't mention charging rent. And so by default, when you charge rent, it is an exempt supply. However, Schedule 10, option to tax, gives somebody that has an interest in land or a commercial property the opportunity to decide they want to charge VAT. If your client hasn't opted to tax, then they can't charge VAT on rent. Rent is an exempt supply without an option to tax. So that is an exempt supply, Alex. Okay? Do you understand that logic? You need to understand why you got the wrong answer. Okay, thank you. Excellent. Excellent. Remember it then. Yeah, please remember it. Okay, let's move on. I'm going to skip over a lot of the option tax stuff. You can't opt to tax part of a building. You can only opt to tax the whole building, even though you may not have an interest in all of it. The option would apply to the whole building. So if later you gained an interest in another floor of it, for example, then the option you made would bind you. The option covers not just the building, but the land the building sits on and what's called the curtilage, the area around the building that's needed for its proper use. If you extend an existing building in any direction, the option you have over the pre-existing building applies to the extension as well. And yeah, I think I'm going to finish with this part. Unfortunately, we won't get a chance to talk about cross-border services. There are a lot of questions which I wanted to answer. Helen, maybe we can run a separate session on services at some other point in time. But let's just talk about disemployment option, and then Stephen, I'll answer your question and any other questions that anybody has before we finish. So an option to tax has no effect over a dwelling. It has no effect over a care home, for example, and it has no effect over a building being used for charitable purposes. So I could opt to tax my home today. HMRC would accept it. But if I rent it out as residential accommodation, I can't charge VAT. You can never charge VAT on residential rental. But if, for example, I rented out the office to a business, then I would have to charge VAT on that. If a charity is occupying part of a building for its charitable purposes, and the landlord opts to tax the building, they cannot charge VAT on the rent to the charity because it has no effect over use by a charity for charitable purposes. So the landlord would have to charge VAT to the other tenants and make an exempt supply of rent to the charity. Now, these last two are quite important. If bare land, oh, and by the way, bare land is not mentioned by the law. So the sale of bare land, the renting of bare land by default is an exempt supply. An option to tax can make it VATable, but by default, it's an exempt supply. Now, if bare land has an option to tax over it, the vendor has an option to tax, and the purchaser either intends to use the land to build their home, or a housing association buys it to build social housing, then the buyer can ask the vendor to set aside the option, disapply the option, and not charge VAT. And if they agree, if the vendor agrees, then the vendor makes an exempt supply of land, which means the purchaser doesn't pay VAT, which means that they don't, there's no VAT, there's no irrecoverable VAT, they can save money. They also save SDLT, because you pay SDLT on the VAT inclusive price. Lastly, from the slides, if a building which wasn't designed as a dwelling or residential property, a residential use property like a care home or a charitable use property, has an option to tax over it. So broadly, if a commercial building, and we're talking about a building, not land, if a building has an option to tax over it, like a warehouse, an office, a factory, and the customer certifies to the buyer that they intend to convert it into a dwelling or a care home or a charitable use building, then they can ask the vendor to set aside the option and make an exempt supply of the building to them. Now, in the second case with the building, the vendor has to be very careful, because if the vendor bought that building 7 years ago and paid VAT, and they used it, they used the building for a taxable supply they were making, then they would have recovered all the input VAT. If I approach them and say, I want to buy your building, but I want to convert it into a care home, or I want to convert it into a block of flats, please disapply the option, that's going to cost them input VAT. Because under the capital goods scheme, they've been making exempt supply to me after 7 years. When they sell the property, they would lose, they'd have to pay back 30% of their input VAT. So they have to know that. So in the second case, the vendor may be less keen to disapply the option. And because we're asking them to, they don't have to. They can say, no, I won't. Yeah, do you want to buy it? Don't you want to buy it? But as soon as we exchange contracts with that in the contract, they're bound by it. So those two are very, very important exceptions where the option is disapplied. Now, we've hit our 12 o'clock finishing time, but I've got 4 questions in the Q&As, which I want to address. If you can't remain for that, I understand you're busy people. It'll be on the recording, so you can just play back the last bit if you want to. So, first question. What is the position, for example, when the landlord charges VAT on business rental, which is then sublet to commercial and residential tenants? Is output VAT applied on the sub? Okay, so Stephen, this picks up a very important point. Just because I opt to tax doesn't bind anybody else. So let's say that I am the landlord and I have opted to tax and I rent you this building. I've got to charge you VAT on the commercial part of it. Yeah, I can't charge you VAT on the residential part, but on the commercial part, I charge you VAT. You have to decide whether you want to opt to tax your interest in the building separately to me. And if you decide that you do want to opt to tax, then when you sublet to commercial tenants, you charge VAT. If you decide not to opt to tax, then you make exempt supplies of rent to both your commercial and your residential tenants. But it means you can't recover the VAT that I'll be charging you on the commercial part. Does that make sense? So just because I've opted doesn't mean that it binds you in any way. Yeah, you have a separate interest in the building as a tenant, and you decide whether you opt to tax yourself. Kashif, investment company owns a property on which input VAT was claimed. Fine, so it must be a commercial property. A residential charity will be acquiring the full share capital in the company, and the property will be used by the charity. They need to charge VAT to the charity on the rent. If the charity is going to use it as, for its charitable purposes, then they can't charge VAT. They're not allowed to. It'll be an exempt supply. If the charity is going to use the property as its admin office, then yes, they would charge VAT if they have opted to tax. Yeah, if they've opted to tax. So it depends on what use the charity is going to make by it. Now, if the charity buys the share capital in the company, what they could do is enter into a group VAT registration. And where there's a group VAT registration, intra-group supplies are outside the scope of VAT. So it does depend on what the charity is using it for. If it uses it as a back office and there's an option to tax in place, that has to be charged. So it might be better to have a group registration because then the supply is outside the scope of that. If the charity is using it for its charitable purposes, its charitable aims, then no, VAT must not be charged. It's an exempt supply. You have to disapply the option in that case. Walter, if a landlord has an option to tax on a building and the whole building after previously being occupied for commercial purposes is then let to a charity, does the option to tax still apply? the option still applies. The option is still over the property, but for the period that it's rented to a charity to use for its charitable purposes, the option is disapplied. It's on this slide, yes? It's on this slide. So therefore, the landlord shouldn't be charging VAT. Now, what if the charity is using most of the building for its charitable aims, but it's using part of the building as a back office, as like an admin office or an accounts office or an HR office? Then the landlord would have to charge VAT on that, on those parts, but not on the parts which are being used for charitable use. Tamar, or Tamar, I'm sorry, I'm not sure which. If a company draws a water well for a new construction of a contractor, would they need to register for HMRC for CIS and invoice with domestic reverse charge? Interesting. It depends why they're drilling. If they are drilling, if they're drilling to test whether construction can go ahead, then that is not within CIS. But if it's already been decided to go ahead and the the drilling of the water well is part of the construction of the property, I don't see why that wouldn't be a construction operation for CIS purposes, which means if they're both VAT registered and the main contractor is going to be passing the cost on, then domestic reverse charge would apply. So Tamar, what you've got to check is whether drilling that water well is a construction operation within the meaning of Section 74 of Finance Act 2004. I'll leave you to research that. And finally, Andy, for late notification, is there a time limit? No, absolutely not. I have filed an option to tax form for a client 18 years after they decided to opt to tax. As long as we can demonstrate they acted in accordance with that option, that's all it needs. So as long as they file VAT returns showing they charged, for example, VAT on rent, and they've recovered relevant input VAT, then late notification, there is no time limit whatsoever, apart from they have to notify before they exchange contracts to sell. That's the only time limit. Okay, Stephen, can you opt to tax retrospectively to cover previous input VAT charge? No, you cannot. You cannot opt retrospectively. You can only, because opting to tax is a matter of fact. It's the point when you decide to charge VAT. So if you decide to opt to tax now, then now is the date of the option. You cannot backdate it. Sorry, not allowed. Okay, listen, it's 6 minutes past 12. I think I've answered quite a lot of questions during the 3-hour session, so much so that my voice is getting a little bit hoarse. So listen, I hope it was a useful session for you. We didn't get time to cover in detail cross-border services. I apologise, but I'd much rather answer questions that are being asked because they're things that affect you than just to rattle through stuff that may be less relevant for you. I'm sure we can pick up on the other topic and other VAT areas as well, perhaps in a future session in the not too distant future. So have a great afternoon, and I'll look forward to seeing you on another occasion soon.